for example, going to the US in this month and next month, because that's where it will show up most quickly in the weekly US import figures and the weekly US stockpile figures. And there's nothing comparable to those anywhere else in the world. The question always is around Russia. And will they actually follow through? They said in February that they would cut output by 500,000 barrels a day in March, and they then sort of extended the duration of that. But we've seen no sign of that in any of the visible flows of oil coming out of Russia. So I think it's important that what they've said this time around is that they will cut exports. So that is going to be very visible. It's going to be visible if they do it, but equally, it's going to very quickly be visible if they don't.
Julian, thank you so much. Really interesting stuff. That's Bloomberg's oil strategist, Julian Lee. Thank you so much for joining. Coming up, why Bank of America and Citigroup say the Fed stress tests have got it wrong. That conversation next on Bloomberg.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Names in global leadership are on Bloomberg.
We have reformed the whole ecosystem around attracting foreign direct investment.
To get everybody to the table was the most difficult thing. Now we're here. The next is consummation.
The commitment is there. Now what we need to see is the actions.
Nobody covers the top global leaders like Bloomberg Television and Radio. Your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
This is Bloomberg Markets. I'm Danny Berger in London. Now, Bank of America and Citigroup say the Fed's stress tests have got it wrong when it comes to projecting their future income. Bank of America says the Fed's too rosy, and Citi says it's too gloomy. It's the latest sign of tensions around the central bank's annual exams. Bloomberg finance editor Tom Metcalf joins us now for more. Now Tom, I know two different sides of the same coin here between Bank of America and Citi, but what is the defining reason these banks say that the Fed has it wrong?
Well, that's, I think, possibly the most interesting part about this. It's pretty hard to unpick from the various statements, which bits they're sort of contesting, as it were, and it's absolutely fascinating. And on one hand, you've got the Bank of America saying, we think these tests are too rosy, at least for them, and Citigroup saying, no, we think the Fed Reserve is too sort of stringent in our case. What we do know is, Bank of America is effectively saying there's something going on in our comprehensive income test that, we differ substantially from the Fed, and for the Citigroup bankers, they're saying, hey, it's more in the sort of non-interest income line. But that's pretty much it. It's an open question, and it's to see this back and forth is a really interesting thing. And it's a good reminder that these stress tests are the methodology is out there, etc. But in some instances, there is a bit of a black box here, and that's presumably what Bank of America and Citigroup are trying to work out.
Well, obviously, these stress tests have implications when it comes to, the bank's capital requirements, things like that. But is this about trying to prevent some of that, or is it about guiding shareholders? Why would these banks come out so strongly, so publicly, and say, we're right, they're wrong?
Yeah, and you're probably right. It's probably around the payouts. This is ultimately what sort of how it feeds back down to shareholders is, if these stress tests are seen as more onerous, then, for example, you'd expect dividend payouts to fall. To be honest, it's not quite as clear cut as that because, Citigroup was one of the ones saying, hey, we're going to actually raise our dividends. So, I think there's, a bit of sort of almost academic here in terms of, the banks going, hey, we really want to understand what's going on here. Even if it's not affecting, say, our payouts now, obviously they don't want to be in a position where they don't quite understand how these stress tests kind of, at least how the Fed is running these stress tests.
No, it's an excellent point. I mean, Citi is certainly still giving us payouts. Hey, Tom, over here in Europe, a great Bloomberg story that Credit Suisse Wealth sent out a memo to its staff basically saying, brush up on your resumes, get ready for this merger. It's my understanding, though, that when it comes to the culling of Credit Suisse as it becomes UBS, they want to keep a lot of these wealth folks, right? What is that dynamic of integrating Credit Suisse Wealth into UBS?
Yeah, exactly. It's the wealth arm, the asset management arm that UBS are doing their best basically to try and keep as much as possible. The various stories in the last few weeks about how they're trying to retain those relationship managers, which makes a lot of sense, right? If you've got a wealth business, the key there are the people because they've got those ins into, the richest people in the world in some cases. So, I found this story very interesting because we've seen a lot about how big the job cuts are going to be at Credit Suisse. That is still the case. But this does go to show there is still definitely opportunities for people at Credit Suisse to stay around with the new organization. But, again, the wording of this memo was not perhaps, sort of particularly charming in any way. It said you've got to be ready to be mobile, burnish, your CVs as we prepare to sort of look out for these lower ranking leadership positions.
Tom, I was going to say, we have the quote up right now saying ahead of the selection process and as these two organizations come together, it's important that we are all as best prepared as possible by showcasing our latest experience and skill set. I got to say, if you were a veteran at Credit Suisse Wealth, wouldn't you be like, this is ridiculous? Like, I've been doing well, my work speaks for itself. I mean, isn't this kind of concerning if you were in, again, that division specifically?
Yeah, it's all in the tone, right? And also how people will interpret this. Like, you could on one hand go, okay, at least they're sort of still considering Credit Suisse people going forward. But on the other hand, I agree, it sort of probably comes across as a bit jarring, especially if you're a long-time worker at Credit Suisse. So, one of those mass emails that went out, I believe, to the whole wealth management division. So I'm sure some people will read it one way and others the other.
Yeah, Tom, I got to tell you, if my manager told me to brush up my CV, I would be very worried. Tom, always a pleasure to speak with you. Bloomberg's Tom Metcalf there. All right, let's turn to tech. A lot of stories we're tracking. For one, Yahoo is planning to return to public markets. CEO Jim Lanzone told the FT in an interview. According to Lanzone, the company is, quote, ready financially, has a great balance sheet, and is very profitable. Bloomberg's Alex Webb now joins us for more. Okay, Alex, we have a lot of stories to go through, so let's quickly touch on this Yahoo one. I mean, this is something in the .com boom was so much bigger. It's much less of what it was now. What do you make of them going back to public markets potentially?
I mean, it was inevitable, really, because they were acquired by Apollo as a private equity play. They'd take it private for a few years, presumably turn it around, make it more profitable, and come back to the market. I'm most interested to see what they've done to its finances in that time, but also how it plays in the IPO market. I think, is going to be a really interesting bellwether there. They're not seeing many deals in that space at the moment.
It's such a bad time to IPO right now.
Yeah, so I mean, look, sometimes when they say soon could be 18 months away, right? But as a bellwether or a test case for IPO markets, it has a big audience. Yahoo still, Apollo, or the CEO says that it's still top 5 global website by traffic. It had I think about $7 billion in revenue in 2020, the last time we have numbers. That makes it bigger than Twitter, but a lot smaller than other tech giants.
Did you know I just wanted to talk to you about Twitter and Threads? That's why you gave me that segue.
So I gave you a little bit of bait and you went straight for it.
I mean, I'm grabbing right on, Alex, because Facebook Meta is launching Threads, the rival to Twitter, apparently this Thursday. The timing here, I mean, it was just this week that I yelled across the newsroom that my tweet deck wasn't working, which is maybe the lamest thing I've ever done. But people are feeling these issues with Twitter right now. Is this strategic in terms of releasing this when we are getting all these complaints, or is this just the timeline was always?
It seems it's hard to know what
fair
Meta is thinking on timing, but essentially we know about this timing because you can pre-order it. Essentially, it's free, but you can pre-order it through the App Store, and on the App Store it says will be available on July the 6th, which is Thursday. The timing seems opportune, given some of the problems, and there's been quite a lot of comment about the fact that if it does launch on Thursday, one thing Meta, Instagram, Facebook, whatever you want to call it, is good at is scaling, right? They have plenty of scale when it comes to server capacity. That is something that seems to have been the issue at Twitter, complaining about scraping data from AI algorithms, but it has to keep really tight control of its costs right now because it's not making as much money as it used to. So the issue that Instagram, which will be, they say Threads and Instagram app, it's unlikely to have similar issues. That positions it quite well to capitalize on it. Nonetheless, it's taken 15, 16 years for Twitter to get to its current scale. It's unlikely that Threads is going to be able to do that inside a quarter or a few months.
I didn't think about that. The fact that this is a time now when Facebook, Meta, Instagram, all of them are cutting down on costs. I mean, how do they justify launching something new amid that?
I mean, look, when we talk about Facebook cutting costs or Meta cutting costs, it's a way bigger company, right? It has, it's something like 20 times by revenue bigger than Twitter is. That means that it has way more wiggle room, then it might as well try this. And it's just developing a new product. The thing is interesting is that Meta doesn't have great track record at launching standalone apps. They've done quite well at incorporating other apps' features into their own. The obvious example is Instagram Stories, which is a fairly shameless rip-off of Snapchat. But when they tried, for example, Facebook Paper, which was a sort of magazine, newspaper app for smartphones, it didn't go very well. So that's going to be the interesting challenge here, how they bring either Twitter's audience over to Threads or their existing audience, user base, into the app. It's clearly not an easy challenge. They have plenty of wiggle room to do it.
Jack Dorsey tweeting, hang on, I have the actual tweet up. Let me read it so I don't misquote it. All your threads belong to us. And he put a screenshot of the data that you're agreeing to allow Threads to capture. Elon Musk, of course, tweeted back saying, yeah. Is there a data concern? Is this different than Twitter, for example, the kind of data they would capture? One
of the things that, as a user, is quite good about Twitter is that they have not been terribly good at taking user data and turning it into revenue. Now, if you're a Twitter investor, that's a bit of a problem because you want to be able to make the most out of the users you have. Their revenue per user is so much lower than Facebook's. Now, that means that actually Meta is able to, from an investor perspective, build a more compelling ad business on the users that it has. It might also mean that users are a bit more nervous, right? Because they have a far better deterministic sense of who is in the end of every account. They know that what your sort of personality profile is, whereas with Twitter, they kind of know the accounts you follow. They don't necessarily know exactly who you are. When you think about Twitter's verified accounts, that's partly about advertising.
Yeah, I was gonna say, last time I checked Twitter in my profile, it thought I was a man, so clearly the data that's gathered on me is
Daniel Berger.
Could use, Danny, also boy's name. Anyway, Alex, thank you very much. Bloomberg's Alex Webb. All right, coming up, we're going to be speaking to Alberto Gallo of Andromeda Capital Management. This is Bloomberg.
The moment news breaks, no one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
I do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. You know, we don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome to this special edition of Bloomberg Markets. I'm Danny Berger in London with U.S. markets closed for the 4th of July holiday. Happy 4th of July to all of you out there if you're still watching from the U.S. Here is the picture when it comes to markets. Volumes are much lighter, about 50% than they usually are here in the European equity trading session. Again, when the U.S. is offline, we don't really have that pickup. Nothing to necessarily guide European markets as the U.S. so often does. So we are higher at this moment, basically erasing yesterday's losses, up by about 0.2%. The future session still underway. Both bond and equity futures are trading in the U.S. We are more or less flat, slightly lower after a very strong first half. Meanwhile, Aussie dollar, that's strengthening after decision from the RBA to hold. But much like the Fed, it was a hawkish hold, talking about the strong possibility that they need to hike later down the line. It is still inflation. It's still too high for their comfort. They're pausing to assess, but they're not quite done yet. Now, Brent finally getting a pickup. We heard from both Saudi and Russia yesterday extending their unilateral oil cuts, that heading into an OPEC symposium this week. We weren't able to see oil sustain any gains yesterday. We've seen that dynamic before, the attempts to move this market from OPEC not necessarily playing out, but today we have it. Brent crude is at $75.64. That is up 1.33%. All right, coming to this overall market environment, it was a strong first half for investors, for stocks specifically, but now there's some more, bearish considerations that maybe they're tempering their expectations for equities for the remainder of this year. Joining us now with his perspective is Alberto Gallo, the CIO and co-founder of Andromeda Capital Management. Alberto, I gotta say, I've seen a lot of commentary basically saying the economy isn't strong enough to keep up risk appetite. I'm looking at a lot of the data in America. It is extremely strong. Are we seeing cracks that will eat into risk appetite for the second half?
Good morning. I think the risk in the second half is really not so much about growth coming off a cliff, but central bankers have only done half of their job against inflation. And you've seen that every central bank that paused had to essentially restart hiking. So we had 500 bips of hikes in the US. Inflation is still strong. The job market is still strong. So what are central bankers not doing here? And there's a question about the balance sheet. There's still very large balance sheets. There's a lot of liquidity. We started a year where everyone had a consensus recession view. We were against that. We said, actually, it's not the recession, it's inflation that's persistent here, and central banks need to do more. Now, the surprise for us has been that risk assets have been still very resilient despite Fed cuts being priced out of the curve. But the reason is the long end of the curve, of the yield curve, is still very inverted. So for a long-term investor, the alternative is still to buy risk assets. They don't have the alternative of buying treasuries. Treasury yields are still too low. So the elephant in the room here is the central bank balance sheet. That's going to determine volatility in the second half of the year.
Alberto, if the Fed, though, is slowing their pace of hike, they're still hiking, are they going to speed up QT also at that point? What happens to their balance sheet with the changes we're seeing in terms of rate hikes?
So I think from here you have two options. One of them is you get immaculate disinflation. So you get to target, which it might be close to 6%. You're getting there slowly, but you've basically told markets it's going to be higher for longer. So you're betting on the duration, you're betting on inflation finally coming down if you keep rates high for a while. But if it doesn't happen, the second option is, what do you do then? Do you keep raising the short-end rates, or do you look at doing something different? And other central banks around the world, like the Bank of England, for example, which is much more behind the curve, have talked about quantitative tightening. And this has created a big mess in the gilt market, with the gilt market going 50 bips wider in a few days. So we're not just looking at the Fed, but think about the Bank of England, and really here it's Japan. The BOJ has bought most of the floating part of the equity market and JGBs, and the BOJ has been the anchor to long-term yields globally. There was a conference with a panel with Powell and Lagarde and Ueda, and Ueda was the only dovish central banker in the room. So that's something that has to change at some point, and it will change probably after Jackson Hole.
You know what the best thing that Ueda did was his jokes, which I'm gonna be honest, Alberto, the bar is so low for central bankers to be funny, but he made this wonderful comment that was something along the lines of, look, we've been in this cycle for 3 decades, so the long and variable lags might be something like 25 years, which got an absolute uproar for the audience. But Alberto, does he kind of have a point? I know he's joking, but we're all talking about long and variable lags. Isn't there some degree where we actually don't know? Are folks just using that as an excuse to say we've had 500 basis points of hikes and there's been no impact? It's got to come at some point?
Look, if you're Microsoft or Apple, you have 10-year treasury at 3.8. You add a little bit of spread. You can borrow at 4%. And then you can buy T-bills or short-dated bonds at 5.5%. If you have assets, you're running a carry trade. If you're a rich mortgage borrower in California and you have, 98% of mortgages are fixed pre-rate hikes. So you have cheap debt and you can invest at short-end rates that are much higher than the rate you borrowed at. So we ran a lot of analysis on yield curve inversion, and only hiking the short-end rates is only hurting the small businesses and the companies that rely on short-term funding. So who is relying on short-term funding? It's people that have credit card debt, people that have auto loans. And unfortunately, this creates even more distortions in the economy. So that, the rich get richer, the large companies do better. You're not hurting the S&P 500. And at some point,
Alberto, do you need to be hurting the S&P 500? Do you need to be seeing cracks in the apples of the world in order to get inflation back down to 2%?
So look, this is the key question. Can central banks get a free lunch? Is there a policy free lunch where we had 15 years of QE almost, and now we're trying to unwind it, and we're expecting that without any damage to the economy? In his last Congress testimony, Jay Powell said, we're trying to reduce inflation, we're trying to keep inflation under control, and we're going to do whatever it takes, but minimizing damage to the economy. This is an inconsistent statement. If you're doing whatever it takes, you're not stopping. There's no conditionality. So this is where the paradox lies. This is why markets don't believe the Fed yet, because they're talking about whatever it takes. So he's trying to repeat Draghi's statement in an hawkish way, in reverse, but is adding conditionality to that. So if you're doing whatever it takes against inflation, you can't always control damage to the economy. So at some point, there is a choice between price stability and financial stability.
Sounds like there's no such thing as a free lunch. Alberto, thank you so much for joining us. It's lunchtime now, so go off and grab yourself something with that. Alberto Gallo, CIO and co-founder at Andromeda Capital Management. All right, let's talk Alibaba, because the Chinese tech giant is exploring options for its video entertainment assets. Now, this is happening as the company has also waded deeper into a plan to revamp its corporate structure. Joining us now is Alex Webb, who covers technology for Bloomberg Quick Take. Alex, you're basically my co-anchor at the moment for this hour, so thanks so much for joining. What do you make of Alibaba's moves here for their video platform?
It's interesting the way they're talking about it. So we know already that Alibaba's in the process of sort of splitting up into 6 different businesses, and its various operating units are getting carved out. Its main video streaming platforms or assets are UQ and To-Do. The thing that's fascinating about this, they're exploring various possibilities. One of them is injecting them into Alibaba Pictures Group, which is its film studio. And the thing that does is it would create a kind of, if that were to happen, it would create something resembling a merger of Netflix, Warner Brothers, and YouTube, right? Which is a very interesting proposition. I should say that the Alibaba media and entertainment businesses have been loss-making. So we saw a little bit of a reaction from Alibaba Pictures Group. So it's got the Alibaba name. It's a separate company in which Alibaba holds a stake. The share reaction was up 6%. Not massive in terms of the declines we've seen this year, but enough to get investors a little bit excited.
And forgive my ignorance, because the overall picture for Alibaba is one of trying to break up the company, right? I mean, this just seems kind of like shuffling things around. How does that relate to what they have been doing?
Well, I mean, look, we're getting the details, essentially, of how that breakup is happening. We don't fully know, we haven't fully heard the rationale from a governmental perspective, but they were coming under a little bit of pressure, as were other Chinese tech giants, for the concentration of power that we were seeing in the likes of Alibaba, the likes of Tencent. By separating them all out, there is a compelling reason to do that from an investment perspective, because perhaps there was a little bit, or perhaps quite a considerable conglomerate discount from having these sometimes fairly disparate businesses all being part of the same group. But it also assuages concerns about the role the governments might play, that the government could still come in and tell them how to do their business. If they are in a bunch of separate, different companies, that is less of a risk from an investment perspective, because perhaps the administration isn't as concerned about that outside power.
Now, in terms of shuffling things around, Yahoo, speaking to the FT, possibly looking at becoming a public company once again. I know you told me that this is kind of expected. Why? Why is this something that we'd say, of course, Yahoo would do this?
Well, because it was acquired by Apollo a few years ago from Verizon for a not insubstantial $5 billion. At some point then, if it's taken by private equity, you assume they want to flip it. It's hard to see who will be a buyer, particularly in the current climate, so therefore IPO becomes the most logical option. Timing is fascinating, given that there is no IPO market seemingly right now. We don't have a firm timeline on when this would happen. It's interesting looking at some of the numbers, though. They say they're profitable. They had about in excess of $7 billion in revenue, which is more than Twitter had, certainly when we last had full visibility into their numbers. Twitter, of course, was valued, now we know perhaps not justifiably, but in the order of $40 billion. Does that mean that they think, well, maybe we can at least get half that? Or I don't know. But if they get in that...
How much of it, though, is about the funding environment? Because it's difficult to get one. As you say, they were owned by Apollo. Financing, the cost of capital is really high right now. I mean, exits haven't really been an option.
The thing that it's interesting, I don't know how many conversations you have with people in the private equity world, but you're seeing a lot of, of course, you were in Berlin recently, yes. So maybe some of the conversations you had there would inform this, but you're starting to see, LPs go, well, actually, I'm not putting any more money in at the moment. I want to see some of my capital come out. You have to wonder whether that might be part of the motivation here, right? That actually, if you look at the money they paid for it, it was $5 billion. They raised $2 billion of debt. They've already raised about $1.6 billion by selling a few assets, not least the rights to Yahoo Japan to SoftBank. It doesn't leave you that much more to actually, for them to be able to cover their face. You don't need to have a huge valuation to get there. So I wonder if actually maybe that's some of the stuff happening behind the scenes. Of course, this is all speculation on my part.
Right.
But it is fascinating that this sort of very old internet company might be a public company once more.
No, you're spot on. I've talked to so many folks who say before LPs are willing to invest in another fundraising round, we gotta give them their money back. Hey, Alex, thank you so much. We're going to get you back, I know, and talk more about Threads, about Twitter. It's a necessary conversation, Alex Webb there. All right, markets in Europe still heading higher. Europe Stock 600, that is up about 0.2%, with the U.S. on holiday. Still oil getting a bid. That is the big mover ahead of an OPEC symposium. We looked at both Russia and Saudi extending their unilateral cuts. There's a concern that the fundamentals aren't matching up with this oil price, so perhaps that's what you need. You need action from OPEC action, which didn't have an impact yesterday, but finally, it's having the impact today on a very light trading day. All right, coming up, massive unrest in France is finally starting to ease with increased police presence. We're going to have more on the economic and political impact of those protests next. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Can you believe it's summer already? That means it's time for the Boston Pops Fireworks Spectacular. And Bloomberg will make sure you see all the fireworks, music, and special appearances by pop superstars En Vogue, chart-topping country duo Low Cash, and film, TV, and Broadway powerhouse Mandy Gonzalez. Plus the U.S. Army Field Band and the cast of the Broadway musical Ragtime. It all starts tonight at 8 p.m. Eastern right here on Bloomberg Television and Radio.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Welcome back to Bloomberg Markets. I'm Danny Berger. French President Emmanuel Macron will meet with local officials from the areas hit by the ongoing riots. Protests were sparked by a police shooting of a 17-year-old of North African descent. An exclusive interview with Bloomberg TV, the chairman of BNP Paribas, France's largest bank, shared his thoughts about the sensitivity of the unrest.
Let's be honest. France is not the only country in which there are tensions in the society. I have seen many of them in democracies, in the United States, in the UK, in other countries. It's part of the life of a democratic society. We need to understand this. It has little to do with competitiveness and attractiveness.
Joining us now for more colors, Paris-based reporter Caroline Conan. Caroline, where do we stand in terms of tensions? Have things calmed down?
Danny, it's been another
quiet night in Paris, in the suburbs, and in major cities across the country. Only about 70 arrests last night compared to like 1,300 on Friday night. So clearly, the things have been calming down. There's been less than 20 arrests, for example, in Paris. Also, one of the reasons is not only the heavy police presence. You've got 45,000 police officers deployed across the country every night for the past week, but also the fact that a lot of these young people have already been arrested, and sometimes they have already been judged. So you've got more than 3,500 arrests for the past week. Most of these arrests are for young people between the age of 14 and 18. The average age is actually 17 years old, and they are facing very tough sanctions. For example, you got this 14-year-old who got 7 months prison term for stealing some sodas after looting one of those supermarkets. So clearly very tough sanctions, and this is how the police is trying to control the situation today.
What has been the impact on Macron? Is he weakened from these events?
He's clearly weakened. I mean, just a few months ago, we had already the protests against pension reform. Now we have these riots. He is actually currently, as we speak, meeting with more than 200 mayors, local mayors of those suburbs who have been affected by all these stores being vandalized and the public buildings being put on fire. But it is expected that he's not going to make any big announcement at times of emotion, because this is something he doesn't like to do. So he's basically saying that he's going to do an X-ray of exactly what's happened over the past week and how the government can respond with longer-term measures in order to deal with the police discrimination, with the undereducation, underemployment in those very poor suburbs. One thing, however, that Macron did mention today was to have some kind of instant fine for the first stupid act, as he said, of those teenagers. So a fine for the parents, because obviously this is also, as the government has been mentioning over the past few days, the responsibility of the parents to prevent these young people from going out and burning cars and participating in these riots.
Caroline, thank you very much for that update. That is Bloomberg's Caroline Conan. Now pivoting to the UK, former Liberal Democrat leader Vince Cable is stressing that the financial pressures from the ongoing Thames water crisis is a sector-wide issue. He spoke earlier to Bloomberg TV's Anna Edwards about the regulatory functions needed in the UK to avoid a potential collapse.
If the investors are willing to put in more cash, then that at least temporarily solves the problem. Of course, Thames Water isn't the only water company in trouble, but a capital raise from the government's point of view is by far the best option, though there will be painful conditions. I mean, I would imagine that the investors are expecting to see prices rise to ensure that there's an adequate return in future. But if the capital raise falls through, then the government is forced back into public ownership, because you can't just allow a water company to collapse. It's a fundamental service. And if that happens, of course, all the liabilities of the company go onto the public sector balance sheet, which in the UK are worrying. We're already 100% debt to GDP. So I think if the government can avoid nationalisation, it will, and will presumably have to make some concessions to the investors to stop that happening.
Yeah. How would you expect this to develop politically, Vince? There does seem to be some pressure from parts of the Labour Party, obviously not your political affiliation, but I'm interested in your assessment. Some Labour MPs calling on the opposition leader to reintroduce policies around renationalisation of water. Would you expect to see that?
Well, there may be calls for it, but I mean, the problem of actually how you handle public debt, which of course was the whole reason behind privatization in the first place, was to try to get these big utilities off the public sector balance sheet. It remains a big problem, but politically there's a lot of anger around. I mean, after all, these water companies have failed to deliver some essential public goods. We've got this problem of overflow of sewage because of underinvestment in the sewage system. There's a lot of leakage. I mean, the real anger is essentially about things in the past.
I mean, it's the way Macquarie took advantage of lax regulation to pay out very large dividends that were completely unjustified in terms of a fairly safe utility. I mean, that anger is there, but of course it's happened in the past. We can't retrieve the past, but the politics of this are quite toxic for the government.
Right, and so do you think that the sector has, I mean, some people have argued that the sector has a private equity problem, not a private ownership problem. From what you've been saying and the strains that renationalisation would put on the public purse, you might agree with that view.
Well, I think where this is heading is to a tougher regulatory regime. I think the problem is not a problem of privatisation, but more a problem of very weak regulatory operations. The regulators in some cases have been captured by the industry. You know, regulators went off to work for the private companies at much higher salaries. The regulation has been applied very flexibly. A lot of things have not been enforced. And I think the pressure will now be on to have a tougher regulatory regime. Now, how you reconcile that with trying to get in more private capital to make up the deficits of investment is a tricky one. And the obvious logic is to move to higher prices, which in turn is very difficult in the middle of a cost of living crisis.
What do you make of the sort of complex structures that seem to exist in some parts of the utility space in the UK, Vince? I'm talking here about layers and layers between operating and holding companies, parts of the company, or many parts of companies issuing debt. This was the situation at Thames Water. Some parts of the company relying on dividends from other parts, domiciled parts of the business in Luxembourg, Cayman Islands. Is there a place for these kind of complex structures in what were previously public utilities?
Yes, well, this is, of course, not just an issue for the water industry, but this is a phenomenon we've seen, and that was essentially how Macquarie, who in a way are somewhat the villains of this story, took advantage of Thames Water, were able to extract very, very large dividends, which were simply not justified. I mean, this is a low-risk utility, after all.
Vince Cable there, the former Liberal Democrats leader and current visiting professor of the London School of Economics and Political Science. An interesting debate unfolding. Is this just a Thames Water issue, or are these companies who loaded up on debt when rates were low and are now unprepared for where we see rates for a BOE that's potentially taking rates to above 6%? Now, when it comes to these markets at the moment, I got to say, not tons of action when it comes to the UK specifically. In general, we are looking at lighter volumes because the US is off on holidays. So stocks are up here in Europe. Futures in the US, those are indeed trading, are basically flat. Here's the interesting one to me. All right, we get an RBA decision this morning. If you're in the US, it was basically overnight for you. They held, but they did say, look, we're not done. We might need to hike more. So the initial reaction was to weaken, to sell Aussie dollar. Now it's stronger, but it's not as strong as the Kiwi dollar. And I would make the argument that these are rallying based off of what oil is doing. These are commodity currencies. Does the RBA risk getting left behind then? It's not strengthening again as much as the Kiwi dollar, because here is oil. This is off the back of both Saudi and Russia extending their price cuts. All right, still ahead, we are going to talk more about the UK. Rob Wood, Chief UK Economist for Bank of America Global Research, shares his views. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome back to Bloomberg Markets. I'm Danny Berger. It's a special edition of Bloomberg Markets because U.S. markets are off. It is the 4th of July. Happy 4th of July. Now, that doesn't mean the setup is any less interesting. Before markets went off on holiday, before they had their early close yesterday, we're looking at the most inverted yield curve in some decades. In fact, it's been 1 year consistently now of a negative yield curve. You contrast that with what's happening in equities, and Europe is certainly picking up the mantle there this morning. We're looking at gains. It was a very strong first half. Are the two of them telling different stories, or are they just deciding to trade on different parts? In the U.S., is it just about momentum? Is it about continued strength in the American economy? Either way, in Europe, it does look like it is some of the cyclical sectors that are weighing on this overall rally, but still we're undoing most of yesterday's losses. S&P 500 futures, those are flat as we await for American markets to reopen tomorrow. Meanwhile, Aussie dollar, that is stronger, but I should say it's not as strong as the Kiwi off the back of stronger oil. Oil is up 1.5%. We had those cuts from OPEC, but not OPEC as a whole, specifically Saudi and Russia. We're going to be talking to our Julian Lee shortly about that. Aussie dollar and Kiwi dollar get a boost. But again, I say it's interesting Aussie dollar not rallying as much just because we did get an RBA decision to hold. The gut punch reaction was to weaken, was to sell Aussie versus dollar. However, we're stronger yet again. They did say more hikes are likely to come. All right, while we're talking about interest rate hikes, let's talk about the UK, because Megan Green, the BOE's newest policymaker, is warning that interest rates may settle at a higher level permanently thanks to a wave of green and artificial intelligence investment that promise to boost economic growth. Now, our next guest also thinks that there will be higher rates for longer and potentially no cuts to come. Rob Wood is the chief UK economist at Bank of America Global Research. He says the UK has an entrenched inflation problem. He joins us now. So, Rob, are you on the same page as Megan Green here? Are we going to have to be higher for longer?
I guess so, yeah. So I certainly think UK interest rates will remain elevated for quite a long time here. The UK, of course, as we've talked about, everyone's talked about endlessly, it has the worst of both worlds. The labour market as tight as the US, an energy shock as big as the euro area, and I think inflation expectations are somewhat de-anchored as well. So I'm looking for the Bank of England to raise interest rates to 5.5%, and I don't think they will be able to cut them certainly before the end of next year, as it takes them quite a long time to bring inflation back down.
Rob, why can't they go to 6% or 6.3, about where this bond market is pricing it at?
Well, they certainly can go there, and I think the risk is that they may have to. If inflation forces them to, if core inflation doesn't slow, which I'm expecting it to gradually, and particularly towards the late summer. But if that doesn't happen, they may well have to keep hiking interest rates. The reason I'm below that peak, though, is I think the Bank of England, rightly is nervous or cautious about the effect that all of these hikes and the further hikes are going to have on households. Is the pass-through of monetary policy delayed or smaller? If it's delayed, then they need to be pretty cautious about how far they head. These levels of mortgage rates are obviously going to put more pressure on households, more pressure on the housing market. So I think the Bank of England would prefer to hike to a lower level and hold it there for longer, rather than put really even more intense pressure on households by peaking at a higher rate. But look, if inflation doesn't slow, then they are going to have to go there.
Rob, I love how you framed that. Is it delayed, or just is the impact smaller? Because for the most part, I'm sure you hear this a lot, everyone's saying it's the long and variable lags. What do you look to figure out that debate? Is there data you use to assess that, or is it simply we got to wait? We got to wait to see what happens.
Well, given it usually takes about 18 months for policy to affect spending, you know, a lot of the answer is going to be that we have to wait, which I think is also why the market is a bit aggressive here in pricing a very high probability of the Bank of England hiking interest rates in 50 basis point increments, because the Bank of England is well aware of this as well, and it's trying to balance, obviously, the risks of going too high with where inflation is. But we can also look at data. For instance, you know, UK growth is holding up. PMI suggested somewhere around 0.25% per quarter, which may well be UK potential growth, actually. The jobs market just added 250,000 jobs in the last 3 months. Job vacancies have been falling but remain very high, and if anything, may have stopped falling lately. So, you know, we should be starting to see the effects of monetary tightening, and it just doesn't seem to be in the growth data. One reason, of course, is that there are now a lot more fixed-rate mortgages in the UK. It used to be almost all floating rate. And this is both delaying the impact of monetary policy, but also reducing it. I mean, people in the past would have paid their interest rate would have been the peak of bank rates, whereas obviously if you're a fixed-rate mortgage, you never quite get that high. The other point as well for the UK, of course, is that there are fewer mortgage holders than there were. So only 30% of people are buying a house with a mortgage, compared to about 45% back in the early 1990s, which significantly reduces, I think, the pass-through of monetary policy. Probably as well, the cash on firms and households' balance sheets also potentially slows down households and firms' response to these higher rates and probably reduces it. So I think it's probably a bit of both. I think one has to be very uncertain, though, given that most of the effects of tighter policy won't get fed through. And I think that's why I think that the market's probably a bit aggressive here in the certainty as it attaches to further 50 basis point rate hikes from the Bank of England.
Rob, you've done some really fascinating work when it comes to UK consumer confidence. It's stable, but how strong are we in that stability?
Yeah, so we at Bank of America run a proprietary UK consumer survey. It's quite interesting. We survey people online, and the sample size is nearly 6,000 people a month, which is significantly higher than other consumer surveys. It's also a real-time survey, so we can see the effect of events and how that affects consumers. And it is really interesting at the moment. So we can see, for instance, that UK consumer confidence is pretty stable, but at quite a weak level. Interestingly, UK consumers' willingness to make a major purchase dropped pretty sharply in the last 2 or 3 weeks as mortgage interest rates began to rise, and obviously this has filled the front page of newspapers. So I think that's one additional marginal reason for the Bank of England to be somewhat cautious. You can see an immediate response from households to those rising rates. What you also see in our survey is inflation expectations. They are declining, both in the short term and the long term, much more in the short term. But in the long term, this decline in inflation expectations is not because everyone is expecting lower inflation. They're not shifting from 5 to 2. It's because the people who were previously expecting greater than 5% inflation are now saying they just don't know where inflation is going to be. Whether that's an improvement or not, I think is questionable. There's certainly a lot more uncertainty around where inflation is going to head. So I wouldn't take these falling inflation expectations, if I was the Bank of England, as a vote of confidence just yet.
Rob, before we let you go, I want to get your thoughts on this Bloomberg analysis, basically looking at savers in the UK versus mortgage payers. I mean, they're often one and the same, but basically saying interest rate increases are benefiting savers more than they're costing mortgage payers. In other words, saying it'll take longer to slow the economy because folks are able to get that extra yield pickup, and that's more beneficial, again, than what it's costing them in mortgages. I'm just wondering what you think of that dynamic and what it means for the direction of this economy and monetary policy.
Yeah, certainly. So the rise in the number of people on fixed rate mortgages is really delaying the pass-through of the Bank of England's rate hikes to consumers. And of course, people have more instant access deposits, more sight deposits where the interest rate is changing. So the big change here is not the rise in saving that people, the returns on saving that people are getting. If anything, deposit rates are somewhat lagging the rise in bank rate. The big change relative to previous cycles is this rise in proportion of people with fixed rate mortgages, which significantly delays the effect of rate hikes on consumers. Only about 20 to 25% of people with a fixed rate mortgage refinance this year. Now, for those people, the effect is severe, and mortgage payments will go up a lot, 50% or more. And their numbers, it's between 400,000 and 500,000 people a quarter. So these are not insignificant numbers of people. But relative to previous cycles, where it would be everyone with a mortgage seeing their mortgage rate change immediately when bank rate changes, or almost everyone, it's a very big change. And absolutely what it does is delay the effect of monetary policy. As I said, though, I think the question is whether it delays it or reduces it. I think there's good reasons to think actually the overall effect of monetary policy is reduced, but also delayed. And again, that's where the Bank of England is going to have to be really, I think it will be cautious. The market is pricing in a really aggressive path, and I think the bank's going to focus on this delay heavily.
Yeah, just going to say, I mean, it's such an extremely fine balance. Of course, the market can go ahead and price in whatever it wants. The stakes for them are maybe lower. I mean, obviously money is on the table, but not the UK economy. Hey, Rob, thank you so much for joining us today. That is Rob Wood from Bank of America. Let's turn now to energy markets. OPEC plus oil ministers, EU officials, and big oil CEOs will gather for the annual OPEC International Seminar tomorrow. Now, this is happening just after Saudi Arabia and Russia extended their oil production cuts, keeping a lid on supply as recession fears linger over the global economy. Here with more insight on how this is impacting global oil is Bloomberg's Julian Lee. Julian, thank you so much for joining yet again.
Pleasure.
Look, we are seeing oil have a pretty solid rally today. Obviously, it's late in holiday trading, but it fell more than 1% yesterday after this announcement. What do you make of that kind of price action?
Well, I think, I will echo the Saudi oil minister here for this is a very rare occurrence.
You want the shorts to ouch?
No, that this isn't about.
I was scared where you were going with that, Julian.
That this isn't about the immediate move in prices. Yeah. This is about, well, he would say it's not about prices at all. It's about balancing supply and demand. I don't quite buy that. But this is about the trajectory of prices over the longer period of time. It's not about a daily move in oil prices. But certainly, the fact that they announce what is effectively 1.5 million barrels a day of additional supply cuts for August and prices fall, that's not quite the reaction that you want. But we're seeing the recovery now, albeit in very thin trading on a US public holiday. But they will be looking at what this does over the next month or two. And for the Saudis now, they have cut their output target, and their production normally follows the target. So they will be cutting output by 20% from this sort of 10.8 to 11 million barrels a day down to 9 million barrels a day. And they're going to need quite a substantial uplift in prices to offset that. And they don't seem to be getting it at the moment. I think their concern is that if they don't do this, there's a real risk of prices falling even further if we get a much slower than anticipated recovery in Chinese oil demand, which is one of the big worries for the second half of the year.
Is there some degree where $75 a barrel Brent doesn't reflect fundamentals? If it is a really tight market, I mean, I know we're dealing with those growth concerns, but I mean, now we have an even tighter oil market.
Yeah, I think, there is a concern. And again, this is one of the things that the producers, I think, keep hammering away at, that this is a paper market price that is affecting or is being affected by broader macro concerns it's not reflecting what is going to be an increasing tightness in the physical oil market. Even without these additional cuts that the Saudis and the Russians have announced, the market was set to tighten dramatically in the second half of the year. And these cuts are just going to make that tightness even more extreme. And I think they are waiting and expecting that at some point the market will start to reflect physical fundamentals and not broader macro fundamentals.
Yeah, maybe got a little sugar rush to get there on its way. Julian, thank you so much. That is Bloomberg's Julian Lee. All right, coming up on the program, we're going to be talking about the big banks. They passed the stress test, but some of them are questioning the results. We're going to have more on the discussions between Bank of America, Citigroup, and the Federal Reserve off the back of more cash return to shareholders. This is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Authorities.
Could face bigger challenges next.
It was going to keep rating World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to Bloomberg Markets. Former FDIC Chair Sheila Bair says not accounting for liquidity and interest rate risks in bank stress tests underscores her view that the current assessment methods need improvement. Bair spoke in an exclusive interview with host of Wall Street Week, David Weston.
I don't think we should take a lot of comfort from it. There's a lot of work that needs to be done. And to its credit, the Fed acknowledged that there are a lot of different potential risks out there that may not be reflected. So I do think we should not take a lot of a lot of comfort in this. The big issue obviously is they don't stress high interest rates. That is the issue confronting the banking industry right now. And ironically, if you assume, as their stress test does, that rates go back to zero in a severe recession, that actually helps banks that have a lot of unrealized losses on their books, because when you take rates back to zero, those low yielding assets regain value quickly. So in a way, they're rewarding banks for not managing their interest rate risk very well, and that's a big problem. The other issue is that, again, related to interest rates, is what happens if we have a protracted period where the yield curve is inverted, meaning that short-term borrowing rates are higher than long-term rates, which is a situation we've had for a while now. That leads you into a situation which we're already seeing, where banks' cost of funding, what they have to pay on deposits or borrowing, will exceed what they can get on their loans. And that's going to be a real challenge for banks. And those are the kinds of issues the Fed really needs to be thinking about and putting banks through. not this kind of artificial assumption that if we have a recession, rates go back to zero and we start the party all over again and their assets are inflated and they don't have to pay anything on the deposits anymore. That's just not realistic.
How does liquidity figure in? Because one of the issues, obviously, on a lot of these banks that failed is they just didn't have the liquidity, so they had to sell the securities, as you pointed out. Does liquidity factor into the stress test? Should it?
It does not really. There are separate tests on liquidity. They're not public, but they probably should be public, and that liquidity risk needs to be integrated into the capital stress testing, because if you cannot separate these out, a bank that is perceived to be weak by the market will likely have deposit runs or accelerated deposit withdrawals. That means that they might have to sell securities they weren't planning on selling, the so-called hold-to-maturity securities, which will have a big impact on capital. So these need to be integrated together. You can't just have a clean separation. And again, that's part of the broader interest rate scenarios, liquidity risk, as they impact capital that the Fed should be running these banks through.
We're talking about the banking sector, the regulated banking sector right now. There's a lot of transactions being done outside of that, as you know so well. And if anything, that has been growing dramatically. Ironically, perhaps, in part because of the difficulties the banks are having. So they're getting out of some of the business that private credit is stepping into. Is there an effective way to take into account the possible systemic risk from the non-bank banks?
So it's a huge issue, because in my experience, we had a lot of non-bank lending during the great financial crisis. They were doing the lion's share of the mortgage lending, right? The big banks were doing the securitizations that fed the beast, but they were doing the lion's share, and they still do, frankly. But those sources of credit dry up very quickly if you get into distressed market situations. The banks that have stable deposits are the ones that keep lending. So if you keep squeezing the banks, and if we overreact, especially with the smaller banks, the regional community banks, to recent failures, you're going to even push even more of that into the private sector. You're going to constrain their ability, the non-bank sector, you're going to constrain their ability to lend, and that's going to make the system even more fragile. There's also not a lot of transparency between the intersection of the regulated banks and the non-bank sector. Again, this was a huge problem during the great financial crisis. Most of the mortgage lending was at the non-banks, but it certainly flowed back into the banks when troubles emerged. So this is another huge area that supervisors have not been sufficiently focused on. We've been talking about non-bank risk for years. There are tools that were provided in Dodd-Frank to deal with it. They're not being used very well. And, just more scrutiny. This is more an issue for the larger banks and the interrelationships that they have with a lot of these private equity funds, venture capital funds, other, so-called private funds. Those losses, to the extent those bank customers are going to have problems, that's probably going to flow back into the larger banks as well. We don't have a good understanding of that risk.
Former FDIC chair there, Sheila Bair, speaking with host of Wall Street Week, David Weston. And a reminder, you can catch Wall Street Week every Friday at 6 p.m. Eastern. All right, let's get more insight on those recent stress test results from Bloomberg's Tom Metcalf. Tom, we had these banks pass, but Citi, among others, was kind of singled out as one that might face higher capital requirements. Separately, late yesterday, we heard both Citi and Bank of America take issue with some of the results, some of the forecasts in the stress test. Exactly what did they take issue with?
Yeah, really fascinating sort of response from both of these banks, effectively saying, look, they need to understand the Fed's methodology a bit clearer because, they effectively disagree with it. And the really interesting thing here is they're not saying, the Fed is proven too stringent. One is saying the Fed is too rosy, and the other, Citi, is saying it is too stringent. So two totally divergent approaches. And I think what it goes to show is these Fed stress tests, their methodology is well set out, but it's such a complicated thing that even the banks involved them need a bit more guidance.
Do these nuances ultimately matter, Tom? I know that's being a little cheeky, but I ask that because we're still getting shareholder, we're still getting payouts to shareholders even with some of the variety in these results.
Yeah, that's the interesting thing. I think if anyone thinks sort of this pushback, might change the sort of level of payouts, I think that's probably unrealistic. I guess what it shows is, just how seriously the banks take this. And, from their point of view, they don't want to have any kind of uncertainty around these things because in the round, these are pretty much the most important tests they go through. And yes, all the banks, all the big lenders in the US did pass the most recent stress test with flying colours. But, perhaps there's going to be a situation in the future where, them passing or not almost hinges on them understanding, the minutiae that they're talking about today.
Tom, while we have you, I want to get the latest on the Credit Suisse UBS merger, and specifically this memo that the Bloomberg team got its hands on from the Credit Suisse wealth side, basically saying brush up on your CV. What were the details there? What are your takeaways from what we were able to see?
Yeah, so look, this is a memo that went out to all of Credit Suisse's wealth management division. And effectively, look, my read of it is it basically management saying, hey, we're still looking to keep plenty of you, but it's going to be a bit of a sort of dog-eat-dog world where, we're effectively going to see who warrants keeping or who warrants taking some low-ranking leadership positions. And we were talking earlier about the precise wording, and it is sort of, you can see if you're receiving this memo, you might find it a bit jarring. It's effectively saying, put your best foot forward. It doesn't matter how long you've been at the company. We're expecting everyone to sort of almost like reapply for positions or apply for new positions.
Yeah, I'm sure what everyone wants to hear, Tom. But look, it's clear though that this reorg. I mean, we've seen it. We saw it in that Bloomberg scoop in terms of cutting folks at Credit Suisse into the newly merged company. I mean, this company is still going to be so UBS dominant, isn't it?
Yeah, exactly. There's been lots of stories about the scale of the cuts. We understand it could be something like 50%, more than 50% of Credit Suisse's overall workforce, ultimately, of a huge swing in cuts. And, really the clear message is, this is not a merger. UBS has taken over Credit Suisse. It's going to keep what it wants. Very happy to pare down things like the investment bank, sales and trade in there. Probably going to get cut to the bone. But conversely, as I think this memo shows, there's some areas, wealth management, asset management, that UBS is very keen to keep, sort of sees it as Credit Suisse's crown jewels, and they're trying to do as much as they can to keep it in place. But obviously, with a huge merger like this, it's a very tricky thing to sort of just wholesale bring in Credit Suisse's assets, because as you expect, lots of assets are fleeing, and plenty of the top talent is also leaving.
Yeah, I mean, look, when you're getting memos like this, when you're looking at the fact of so many folks are going to be losing their job, it's hard to retain talent in that sort of atmosphere. Tom, thank you so much for that update, everything from U.S. to Switzerland. Tom Metcalf there of Bloomberg News. Now, coming up, we're going to get more market insight from Jeremy Stretch, CIBC head of G10 FX strategy. That's up ahead on Bloomberg.
Welcome back to another special Wimbledon update for Bloomberg TV and radio from Tennis Channel. I'm Andrew Guy. Defending champion Novak Djokovic eased into the second round with a comfortable opening win over Argentina's Pedro Cachin. The world #1 keeping his perfect record in the first round at the grass court slam intact. The Serb is looking for his 8th crown in London and to extend his lead on the all-time list at the slams. And don't forget, you can watch all the action daily at 5 p.m. Eastern on Tennis Channel.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Names in global leadership are on Bloomberg.
We have reformed the whole ecosystem around attracting foreign direct investment.
To get everybody to the table was the most difficult thing. Now we're here. The next is consummation.
The commitment is there. Now what we need to see is the actions.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
Welcome to Bloomberg Markets and happy 4th of July. That means it is Independence Day. The U.S. is offline, so we're going without American markets today. Futures are still trading. They're basically unchanged, and volumes are lighter here in Europe, but equities are heading higher, basically erasing yesterday's losses. It's still a day of central bank action, despite the fact we have a country that is offline. The RBA decided to pause. It was the same hawkish pause we've grown to know and love so well from the Fed, saying that we're not moving this time, but it is very likely that we will indeed have to hike later. It is yet again another central bank that not just pauses, but signifies that they're not ending, that they still have further to go. Also on light holiday trading, Brent crude is higher, up by 1 and almost 2% at this point, more than 1.5%. We're about to get into an OPEC seminar, a meeting of OPEC Plus members. Ahead of that, we had both Saudi and Russia announcing that they would continue their oil cuts. And we've seen the price reaction. There's this element where perhaps they want this to more closely reflect fundamentals, that it's not, that $78 a barrel where we're at perhaps isn't high enough given just how tight the crude and oil market is. All right, let's turn to the world of tech. So Instagram's highly anticipated Twitter rival is expected to launch this week on Thursday. The app is going to be called Threads. For more, let's get some insight into what to expect. It is Bloomberg's Alex Webb who joins us now. Okay, so Threads, it launches this Thursday. How much can it capitalize over some of the recent turbulence over at Twitter?
Look, it took 16, 17 years for Twitter to get to the scale that it has today, which is, in the order of 250, I think, million active users. Threads is not going to be doing that over a compressed time frame. Nonetheless, Facebook and Meta have a far better oiled advertising machine than Twitter has. So there is, if they get it right, the potential for quite a lot of upside. One interesting thing to look at, though, if you think actually about the closest rival to Twitter, it's probably LinkedIn. Sort of professional audience, often, people, there's a lot of media and journalists and politicians on Twitter, but sort of adjacent in LinkedIn. They haven't actually benefited massively yet, at least, from all the issues at Twitter. The revenue's up 200 million year on year in the most recent quarter. Maybe there's a bit of a lag as some of the advertisers change tack and look towards them, but it may be quite a good metric for the sort of space being vacated by Twitter, and at the very least, the timescale required to fill it.
I mean, having another social media platform launch amid a lot of other ones launching seems a bit daunting for advertisers to try to get their grip on where they should be more, where they should be less. I know we don't know the pitch for advertisers, but what do you figure it would be from Threads, from Meta, to say, okay, we know we're new, but come advertise with us?
Well, it's a lot easier for them than it would be for, say, Blue Sky, right? The rival being ginned up by former Twitter executives, because Meta has the existing relationships with advertisers, so they can go along and they say, well, look, if you want to get the cool, trendy young kids, we've got Instagram. If you want to get a different demographic I won't identify, you can use Facebook. And if you want to get more of a sort of media trend set, news agenda setting audience, then we hope to have Threads. It's easier for them to build that up. And also, you can just pump the same ads through these different channels. If you're selling it on the basis of the people you reach rather than the platform you use, then there might be nothing stopping them pumping it through that. So that is, clearly an opportunity for them. They have far better, in advertising, you're talking quite a lot about probabilistic and deterministic advertising. So probabilistic is, we think they vaguely fit this demographic. Deterministic is, we know exactly who is on the end of this device, who is watching this piece of content. Deterministic is the stuff that people want, because then they can target their ads with far greater accuracy, even with some of the anonymity settings that are now in play because of things like GDPR. Facebook, Instagram, Meta have that very good deterministic data, and that is something that Twitter generally doesn't have. One of the reasons that Twitter actually was introducing the verification blue ticks, sure, partly it's a revenue play, but also it's about knowing exactly who is on the end of a given account, which actually helps them target better ads.
In terms of the uphill battle that Meta faces from here, we talked about this earlier. I mean, Jack Dorsey, look, it makes sense they'd take aim at them because Jack Dorsey has Blue Sky now, Elon Musk has Twitter, Jack Dorsey saying, okay, all your threads belong to us, tweeting the data privacy policy, and then you have Elon Musk replying to that thread saying, yeah, very eloquent from the both of them. But, to that point, you say it's really good for advertisers. Meta knows this very well. Is there some degree where it's bad for users that in this age where we're perhaps becoming more alert, that it will hold people off from signing up?
You might think so, but actually, the thing that has seemingly caused the shift out of the Blue app, Facebook itself, isn't necessarily about ads itself. It isn't about people sacrificing their data. People seem to actually be relatively blasé about handing their data over. The thing that's actually hurt them is the quality of the ads you see on Facebook and just generally the quality of the content you see on Facebook. It is nonetheless interesting that this is being marketed. If the way we know that it's coming on Thursday, or suspect it's coming on Thursday, is that on the App Store it says expected on the 6th of July, because you can pre-order the download, as it were, and it says Threads and Instagram app. It doesn't say Threads a Meta app. It doesn't say for Threads a Facebook app. Instagram is perceived as being the safest or the shiniest in a way as well of Meta's brands. It is therefore keener to seemingly associate it with that than it is with the Blue app, which is associated with a slightly older demographic these days.
Very interesting, Alex. Thank you so much. That is Bloomberg Quick Takes, Alex Webb. All right, obviously, American tech is not trading today. Meta is not trading. But for the rest of these markets, we're still digesting moves from the RBA, a hawkish hold that at the moment means we're looking at a stronger Aussie dollar. Let's get more of a perspective on markets and get over to Jeremy Stretch, CIBC's head of G10 FX strategy. Jeremy, really great to speak with you today. All right, initial reaction from the Aussie dollar was to weaken. We're stronger now, maybe getting a lift from oil prices. But I do just wonder more generally, in a world where the Fed has really amped up their hawkish rhetoric, does central banks like the RBA, like the krona, do they risk being left behind?
I'm not sure they necessarily risk being left behind, but I think clearly the market was mindful that there could be a risk of an RBA tightening today. But ultimately, there was only pricing in 8 or 9 beats of tightening for this current decision. So in a sense, we've come out of the other side with the market now saying, well, we think there's a reasonable probability of an additional adjustment coming at the August the 1st meeting. We do get the quarterly inflation report prior to then, and assuming that continues to suggest that inflationary pressures remain relatively significant, then I think that's the reason why the dip in the Aussie proved to be relatively shallow. We've seen investors buying that dip because there is still that presumption that the RBA are not yet done in terms of policy tightening. And there is still scope for the currency to get some traction off the basis of both the RBA, but also still this presumption that there may well be additional stimulus coming down the pipe from China, which will provide a benefit to the Australia in terms of trade. So it is very much a case of looking for the 200-day moving average, which we're very close to currently. And if we can close above there, then I think it will amplify the presumption that the RBA is still very much in play, with August the 1st still looking as a reasonable probability for additional policy tightening.
The RBA is still in play. The Fed, the ECB, we heard it all in Sintra last week, right, Jeremy? We heard this hawkishness coming from central banks, and you contrast that with Ueda on the panel. You contrast that with China, as you say, putting out stimulus. How much is the second half of this year going to...
Where clearly investors are looking for carry and will certainly favour carry, and that has been the theme that's predominated over the course of the last few weeks and months. I guess the question will be, how much further do the central banks have to go in terms of policy tightening? We're expecting 2 more hikes from both the ECB and the Fed, but in a sense, we do have that situation where there is less price for the Fed than perhaps there is for the ECB. So I think that is worth putting in play. And I think also in the context of the BOJ, I think there is going to be an increasing degree of focus on when the BOJ will consider adjusting policy, because as Ueda said at last week's Central Forum, inflation expectations are moving higher. We are seeing some degree of inflationary impetus coming through in terms of Japan. And I think in the context of the upcoming CPI revisions in the BOJ's forecast remit, I think if we do see upgrades in those when we get those later this month, and we see some resilience in the earnings data, then I think we can start to see some semblance of discussion about policy adjustment coming from the BOJ. Maybe not at this next meeting, but certainly through the course of this quarter. So I think there will be some degree of alteration in terms of this dynamic, that the BOJ is the central bank that's sitting on the sidelines, and it's been very much the ECB and the Fed that have been driving forward, particularly aggressively, obviously with still, as I say, probably 2 25 basis point adjustments favoured for both over the course of the next 2 to 3 months.
Now, you mentioned there the difference in pricing between the Fed and the ECB. We were talking to Jordan Rochester about an hour or so ago, who basically said that the euro is going to be able to break out of this range because the ECB will be higher for longer. They're behind the hiking cycle of the Fed. I got to say, Jeremy, it's not what this market is doing. This market is really preventing euro from breaking out anywhere. Do you agree with him? Are we going to get that topside breakout from euro versus the dollar?
I think we are, but I think unfortunately you're going to have to be relatively patient for those that are anticipating it. So yes, I would expect to see euro-dollar ending the year maybe at sort of 113, perhaps of that sort of magnitude. But I think it is going to be a story for Q4 rather than necessarily Q3, because our base case presumption is that we still get 2 hikes from the ECB, although of course we will continue to monitor the data in order to facilitate that 25 basis point hike post the ECB summer recess. But I think there is still an underpricing in terms of Fed expectations for the September FOMC. So I think there is an opportunity that can and will result in eurodollar maybe drifting a little bit lower first. But I think as we go through Q4 and we get to that realization that the ECB will remain higher for longer, I think there will be very much a case that the Fed will be looking to adjust policy far earlier than the ECB in the context of 2024. Then I think that's the timing that will encourage that range break. So I think euro bills have to be relatively patient. We've already seen, obviously, euro positioning proven to be relatively excessive. So we're already looking at real money players that are holding net positions that are around 1.5 times the 1-year moving average. So we're already pretty long of euros. We need to see a paring back of some of those positions over the summer. And then I think Q4 will be the opportunity to encourage that range break and a push to the top side.
Just quickly here, Jeremy, because we're almost out of time. How confusing is the American data right now in trying to get a handle of where the Fed goes from here? ISM manufacturing is weak. All the other data last week was so strong.
Well, I think in a sense what we're seeing is a manufacturing recession, which is really evident. So in a sense, we've seen a rapid pace of monetary policy tightening globally over the course of the last 12 months, and manufacturing is much more responsive to tighter monetary policy. So we're seeing manufacturing data proving to deteriorate quite fast, particularly in the context of German manufacturing PMI. But services sentiment, which is no longer quite so responsive or not as responsive to monetary policy tightening, remains pretty robust. And that's really the delineation between macroeconomic performance. So those economies that do have a greater preponderance on services as opposed to manufacturing, and that includes the US and the UK, are performing rather better than perhaps would otherwise have been the case in the context of those that are much more driven by manufacturing. So that's the sort of the real divergence trade. So I think the US economy will be reflecting that service sector resilience, and that will be played out in terms of the employment backdrop, and that will keep the Fed biased and predicated towards additional tightening over the course of the next couple of meetings.
Yeah, certainly the woes in Germany come to mind for that. Jeremy, thank you so much. Unfortunately, that's all we have time for. Really appreciate you joining Jeremy Stretch of CIBC. All right, coming up, the massive unrest in France is starting to taper out due to increased police presence. More on the economic and political costs of the protests next on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. The moment news breaks, no one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
Welcome back to Bloomberg Markets. French President Emmanuel Macron will meet with local officials from the areas hit by ongoing riots. Protests were sparked by a police shooting of a 17-year-old of North African descent. An exclusive interview with Bloomberg TV, the chairman of BNP Paribas, France's biggest bank, shared his thoughts about the sensitivity of the unrest.
Let's be honest. France is not the only country in which there are tensions in the society. I have seen many of them in democracies, in the United States, in the UK, in other countries. It's part of the life of a democratic society. We need to understand this. It has little to do with competitiveness and attractiveness.
Joining us now for more is Bloomberg News reporter Caroline Conan. Caroline, let's start with the scenes right now. How do things stand? Is it more calm?
It's been a quieter night, and Sunday was also a quieter night than the past few days. So clearly, it seems like the situation is getting under control. In fact, Emmanuel Macron is meeting with the mayors as we speak at the Élysée Palace, and he said himself that he thinks that the peak of the violence has passed. He also promised those mayors, more than 200 of them gathered at the Élysée Palace right now, that there will be a strong response from the authorities in order to help repair all these public buildings, these schools, this public transport infrastructure that have been damaged over the past few days. And clearly, these mayors, they have been at the front line of all this urban violence over the past few days. So they are very important in the response that Emmanuel Macron is planning to provide over the next few days.
In terms of that response, in terms of what Macron has done, is his position weakened with all of this?
Well, of course it is. I mean, there's on one side the financial impact. The MEDEF, which is France's biggest business lobby, was estimating this morning that the riots probably have caused at least 1 billion euros in damages to shops, to supermarkets, to banks, etc. But then, of course, you have the political impact. And clearly there is this big divide in the French society between two totally opposed ideologies. So those who actually say that we should understand the revolt, we should understand these neighborhoods where you have a lot of undereducated, underemployed young people of immigrant descent that are not integrated as much as other young people in the French Republic and in the French society. For example, the far left of Jean-Luc Mélenchon has not really condemned the violence, but they have said that they understood the revolt and that these issues, these deep issues of racism and discrimination should be addressed. And then, of course, on the other side, you have the right wing of Éric Ciotti and the far right wing of Marine Le Pen, for example, who have been saying that the response from the state, from the public authorities, has not been strong enough, and that the state should be there to ensure public safety and to control immigration. For example, the head of the National Rally has said that the family allowances to the parents of those teenagers involved in the riots should be scrapped. So, of course, a huge debate has started here in France, and this opposition between these two ideologies will probably keep going in the political debate, in the political landscape over the next few weeks.
All right, so very, very different narratives you're laying out there, Caroline. How has social media played into all of this?
In fact, Emmanuel Macron has accused social media of making this violence escalate. He actually said this was because of video games, which obviously is something that he has been criticized for saying. But clearly, there has been a lot of these violent images of these cars burning on social media, on TikTok, on Snapchat. And clearly, this is the social media that all these young people, because usually the rioters are between the age of 14 and 18, and they use this social media on a daily basis. For example, the French social media Brut has seen their subscribers increase by 700,000 subscribers over the past week. So now they have more than 5 million, which is basically the same reach as the Daily Mail on TikTok. So basically a huge impact from the social media as well. And this is also an issue that needs to be addressed.
Caroline, thank you very much. That is Bloomberg's Caroline Conan in Paris. Now, let's bring you more of that conversation that we had with BNP Paribas Chairman Jean Lemaire, who spoke to Bloomberg's Anna Edwards and Tom McKenzie, not just about what's happening in Paris, but also the company's growth outlook and how BNP is ready for a rebound.
On market reaction, you know, it's a long debate. We have a long debate about the valuation of stocks, difference between the US and Europe. You know it well. We have a high dividend or reasonably high dividend. We serve well the shareholders. It's up to the market to appreciate the value they want to give. But of course, I would welcome a better appreciation. Now, on the point you have made, which is, what are we going to do? The main trend in BNP Paribas is to support organic growth in a well-diversified business model we have all across the world, notably in global market activities. So you know that we have sold Bank of the West, And we are going to use the money of this operation to support the business, but mainly in an organic way.
Okay, so mainly the focus on that organic growth story. Okay, growth is supported. Jean, can I ask you about Paris as a financial services hub? It does seem that in terms of continental Europe's attempt to build up competition to London, that Paris has done very well at attracting banks to expand. Bank of America, JP Morgan, Goldman Sachs, Citigroup. Is this putting strain on any of the infrastructure? Is this something that we'll see more of?
Well, as a whole, the continent has done well. You have Paris, you have Amsterdam, you have Dublin, you have Frankfurt. All of us, I think, all the financial places in Europe have done well after Brexit. For obvious reasons, clients are on the continent, and it's easier to operate from the continent and to serve the clients in the continent. This is the reason why most of the banks have shifted staff and skills to the continent, and Paris is probably leading this, which is positive from my point of view, for various reasons. It will continue, and you have raised a very important question, which is the quality of financial infrastructure on the continent in the Eurozone. We should never forget that since the decision was made on Brexit, the competitiveness of the continent, the work has been delivered. On the continent, people are working hard to build up better, stronger infrastructure, financial infrastructure. Time is running away, and with this, we see an increased competitiveness. So I know this is a debate, a sensitive debate between the UK and the city and the continent, but you know, people are working hard to improve, and they do, and you see the results.
That was BNP Paribas Chairman Jean Lemaire speaking exclusively to Bloomberg TV. Now, market action is certainly lighter. Volumes are lighter, about 50% of where they usually are for this equity market trade. We're off the highs for the session in Europe. We more or less have erased yesterday's losses, but it was a strong first half for equities. Can that continue into the second half? Jeremy Stretch was talking about the fact from CIBC, who was just with us, that manufacturing tilted economies are the ones that are going to struggle. It is still that bullwhip, that COVID bullwhip, that's having its impact on manufacturing. Services are doing better, hence the strength in the U.S., hence the strength we have seen in stocks in the U.S. Of course, we're basically flat. Aussie dollar, that also gains off the back of a RBA hawkish pause, yet another central bank that is taking that rhetoric, but more or less it is this hawkishness that's been whipping up from the ECB, from the Fed, from the RBA. Inflation is not yet conquered. Brent crude, that's almost up 2%. Yes, the trading is lighter here, but we're finally seeing an impact from both Russia and Saudi extending their oil cuts, their output cuts. We're going to get an OPEC plus symposium, a seminar. Basically, we're going to have a meeting of OPEC. So we're just talking to our Julian Lee about this, the fact that they announced these cuts before the seminar, basically to get out of the way so it didn't overshadow the whole thing. They want to talk investing, infrastructure, that sort of thing. Now, elsewhere, we are seeing the yen consolidate, in the dollar yen consolidate, I should say. Yen is moving higher today. We did get to that 145 level last week, and that's where we got the jawboning from officials. All right, still ahead. What will the second half of the year look like? That's next.
and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, aren't you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Welcome back to Bloomberg Markets. It's the 4th of July, so volumes are decidedly lighter. We don't have a cash trade for American equities or American bonds. We are up and running here in Europe. We're up about 0.2% off the highs. Germany, that is underperforming. Most other regions are higher. Aussie dollar getting a bid after the RBA held, but it was a hawkish hold, saying that they have further to go. You might have heard that before from the Fed. Finally, Brent crude, that is up more than 1.5%. And that is as OPEC plus oil ministers, EU officials, and big oil CEOs gather for the annual OPEC International Seminar tomorrow. Now, specifically on those prices, that's in reaction to Saudi Arabia and Russia extending their oil production cuts, keeping a lid on supply as recession fears linger over the global economy. Here with more insight on that is Bloomberg's Julian Lee. So, Julian, why announce these cuts ahead of the seminar?
Because I think then it allows the seminar to focus on the program that they've put together, which is looking at the energy transmission, at reducing methane and other emissions from oil and gas production, looking at the investment needs in the energy space going forwards. And I think the last thing that the Saudis wanted was all the media attention on will they extend their cuts, won't they extend their cuts, which would overshadow this meeting. This isn't a policy meeting. So I think getting the policy out of the way then allows this seminar to just be a seminar.
Is there some degree which it might overshadow it anyway, especially because these cuts are unilateral? I mean, it's not the whole of OPEC doing this. How prominent will that be in the discussions regardless?
I think the expectation was always there that Saudi Arabia would extend these cuts. I mean, it announced a month ago that it would make a unilateral cut of 1 million barrels a day in July and said that it might extend those if it felt it was necessary. So I think there was always that expectation there that it might do. We did a survey of traders and analysts last week, and almost unanimously they expected this cut to be extended. And if you look at what's happened to oil prices, that really haven't picked up after the first cut. In fact, they've gone in the opposite direction. It was quite clear that they were going to have to extend this cut. The surprise, perhaps, is that Russia has come on board and announced a cut of its own. And importantly, the Russians have said explicitly that they will cut exports. And this has been the problem with Russia up till now. They announced an output cut, really in response to Western sanctions on Russian oil and price caps on Russian oil exports. They announced an output cut, but we really haven't seen any evidence of it in the flows of Russian oil that we can see coming onto international markets. And that's what's really important. So I think that what they have said now really steps this up by saying that they will cut exports. We will be able to see that very quickly if they do, and equally if they don't.
So assuming they do, just how tight is this oil market?
Well, it's going to get a lot tighter than it is now, according to virtually everybody's forecast. We've had a somewhat of a surplus in the first half of the year, not desperately big by historical standards, but that is set to shift to a deficit in the second half of the year, even before we had these cuts by Saudi Arabia and Russia. Initially, it was looking at being somewhere around 1.5 million barrels a day of deficit. If we get these full cuts, and if they're extended beyond August, that could become as much as 3 million barrels a day if it's implemented in full, and if demand growth is, you know, on a level with what people are expecting at the moment. And there are some concerns that maybe China's oil demand isn't going to pick up quite as quickly as some of the forecasters have been suggesting.
How does, if we do see, I mean, I know we haven't seen it yet, it's been mostly small scale but consistent stimulus in China. If we do see more stimulus, not just in terms of continuation, but in scale, how does that shake up oil prices at this point, if so much of it does hinge on that lessened demand?
Yeah, I think if we do get a stimulus in China that really starts to boost Chinese industry, Chinese construction, road building and things like that, then I think we very quickly start to see the oil market tighten. And, you know, the OPEC Plus group of oil producers makes a big song and dance about how responsive they are, how forward-looking they are, how concerned they are about balance of supply and demand. So if things do start to move dramatically to the upside, those claims may well be put to the test before the end of the year. We'll wait and see.
Okay, no, we're dealing with a whole lot of hypotheticals here, so this is not an easy question. But outlook for the second half in oil prices, is the path of least resistance just higher from here then?
I think if you look at most people's forecasts, and I no longer forecast oil prices, that's not my job since I've moved to Bloomberg.
You're probably okay with that too.
I'm very okay with that. If you look at most people's forecasts, those forecasts are for prices to rise over the second half of the year, but they're not for prices to rise anything like as strongly as they were forecasting back at the beginning of 2023. Back then, we were seeing almost everybody forecasting oil prices hitting $100 a barrel sometime in the second half of the year. You're not seeing that anymore. People are now talking about perhaps $80, $85 a barrel, and that is partly on the fact that we've seen more supply than people were anticipating in the first half of the year. Russian production hasn't fallen in the way that people anticipated it to. Some other countries have been producing a bit more. Iranian production is up, Venezuelan production is up. So you've had that additional supply, and you're also seeing these fears about the global economy and about the pace of Chinese oil demand growth going forwards.
All right, Julian, thank you so much for joining on that oil outlook. That is Bloomberg's Julian Lee. All right, let's turn now to economic data. Inflation in the Eurozone, it is falling from a record high, but it's still far above the ECB's 2% target. European Central Bank policymaker Joachim Nagel reaffirmed yesterday that the central bank has a long way to go to raising interest rates. Let's get some perspective now from Holger Schmieding, chief economist at Berenberg Bank. Holger, so great to see you in person. Always a pleasure to have you in the studio. Look, Nagel certainly talking the hawkish game. We heard from Sintra yesterday, Christine Lagarde, same story there. How much higher and for how much longer are you expecting from the ECB? Are they going to walk the walk along with talking the talk?
They will, yes, walk the walk for a while. The rate hike in July is pretty much a done deal. September is a possibility. But the ECB is far too optimistic as to the growth outlook for Europe. They expect 0.9% growth this year. They expect significant growth over the summer. If we look at recent indicators, manufacturing is heading for a recession, serious global headwinds. I think that in September they will have to revise down their forecast for growth quite a lot. And then probably the doves will say, look, if growth is significantly weaker than expected, then probably core inflation, underlying inflation, ought to be weaker in the future as well. So let's stop. There's one thing, however, as to the higher for longer story, where I believe in, namely the for longer. Unlike the Fed, the ECB probably next year will not cut rates.
What do they do with the balance sheet then?
Well, they let the balance sheet shrink and shrink and shrink.
Do they need to speed up the pace of that? Do
No.
they go further than just letting it roll off?
Absolutely not. The balance sheet, with these long-term liquidity injections retiring over time, banks paying them back, and with the ECB no longer reinvesting the proceeds from maturing bonds under its big APP program, the balance sheet of the ECB by the end of next year, relative to GDP, will only be slightly above where it was pre-pandemic. Give it another year, 2025, and the balance sheet of the ECB will look normal without the bank having to speed up the process. So, my question, why rock the boat by speeding up the process?
Just to put a finer point on what you said just moments ago, this idea that the ECB can hold at a higher rate, whereas the Fed maybe not. What is that divide that might force the Fed's hand sooner than the ECB?
Well, ultimately, it's a question of what's their target. The ECB has one target, 2% inflation, and say, at least half of those at the ECB board really take it literal in the sense of 2% means 2.0. And it will be a long time before inflation is all the way down to 2.0% on a sustained basis. So next year, probably, the hawks at the ECB will say, well, while the Fed is cutting rates, we, with inflation above 2%, shouldn't. Whereas the Fed, with its balance between unemployment and inflation, will probably conclude earlier. Inflation is heading the right way. It's getting close to 3%. We see finally late this year softness in the labor market, early next year more softness in the US labor market. So they'll probably start cutting rates early next year for the sake of the labor market.
Holger, I'm going to be honest, I've really been trying to hold myself back from having an R-starred conversation because I feel like a lot of people probably already turned off the TV hearing me say the word R-starred, but yes. I think this debate is an interesting one of where equilibrium in rates is. Is there some degree which, given COVID, given the stimulus we saw coming out of it, that models in trying to figure out that equilibrium kind of don't work, that we can't really rely on them as we once did?
That's absolutely the point. Well, actually, in the past, we couldn't rely on R-star very much either. Remember, there have been lots of revisions by economic historians as to what R-star probably really was. It's an interesting concept. It's not a useful guide. But in a period where we have had the pandemic, where we've had Russia's war against Ukraine, unfortunately, we're still having it, with these unusual supply shocks, supply chain pressures, yeah, with all these unusual things, how can a model that's based on past experience without any of these shocks come up with answers that are good enough to rely on? In other words, we really have to lean back, look at the big picture, and the big picture for the US is rates are high, probably going a bit higher. Inflation is gradually softening, the economy is gradually softening, and as monetary policy works with a lag, the Fed should stop soon and then reverse some of its tightening next year.
So then is pausing and going at it slower, is that in some ways an acknowledgement of that environment? And are they doing the right thing in that case? Or are you still seeing, I mean, we can venture outside the Fed for this, but central banks that are too overly reliant on models?
Central banks have been too overly relying on models, which actually is the reason why they missed the initial inflation problem, because their models did not have this longer-term wage element coming from simply demographic reasons, shortage of labor. So their models missed that inflation is trending up anyway, regardless of all these funny things. So much about the models. What the central banks really should do is look at the evidence with an open mind and be very mindful of the point that monetary policy works with a lag. We all know that, but they are often too close to looking at what's current inflation, especially the core inflation, rather than thinking, okay, headline inflation is coming down. That will likely mean that core inflation will come down significantly as the lagged impact, for instance, of energy costs on goods and services prices, yeah? Our hairdresser needs to heat her room, yeah?
Right.
All this will mean there will be positive base effects reducing inflation in the future, and central banks, in my view, are not really paying enough attention to this kind of outlook.
Is it just the lag, or is it also the transmission mechanism in terms of the overall impact, the size of the impact? Is there some degree now where monetary policy tightening, again, not just that it's taking longer to filter through, but it's just filtering through less?
It's filtering through less than in the past for a number of reasons, which we only partly understand, of course. One reason is consumers have the excess savings built up during the pandemic. Companies have good balance sheets, and banks are by and large in good shape. And on top of that, banks are being protected by central banks and regulators from turmoil. And on top of that, we have to remember that a significant part of these extremely low rates were a kind of insurance policy against pandemic risks. That is, if you think, okay, the Fed's going up 4.5 percentage points, the first 2.5 percentage points of that was just taking out no longer required insurance. So it's actually only everything on top of that, which we should compare to previous monetary tightenings. So in retrospect, it's not such a big surprise that the economies are holding up relatively well against higher rates.
Holger, this has been so fascinating. I'm afraid this is all we have time for. Thank you so much for joining. Really appreciate it. That is Holger Schmieding, Chief Economist at Berenberg. Coming up, 2 major U.S. banks push back on the Fed in the wake of the latest round of stress tests. We're going to get into the details of that next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City,
From London and Sydney.
from Washington,
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Welcome to Bloomberg Markets. I'm Danny Berger. Blackstone CFO Michael Chase says artificial intelligence is likely to give private market investing a big leg up. He spoke with Bloomberg's David Weston on Wall Street Week. Here's what he had to say.
We've been focusing on the potential in this area for a while. I'd first, just big picture, say that I believe AI will reinforce and further the advantages of private market investing relative to public market investing.
Why is that?
Well, I think the reason for that is it's actually pretty simple. Public market investing, which relies obviously on publicly available data, that sort of data will be increasingly and further commoditized in an AI world. And in contrast, the value of proprietary data and insights that you can glean from a really large private market portfolio accumulated over many years across many businesses, the value of that sort of information and data and ability to mine insights from that and have pattern recognition coming out of that, both longitudinally and across your business, that will only be further enhanced, again, relative to public market investing. So I think that is a big picture perspective. For us on our business, you mentioned this, first operationally, I think for sure over time, there'll be efficiency gains in our business processes and our operating processes from leveraging these tools. And then on the investing side, which you were getting at, Obviously, lots of focus. You could say there's a bit of a gold rush mentality right now.
As CFO of Blackstone, you're looking not just at the here and now, this quarter, next quarter, but the longer term. Take us into the longer-term future for Blackstone. I mean, you're very, very big right now by most measurements. It gets harder to grow at the same rate as you get bigger. What is the path forward for Blackstone to maintain the sort of growth that it's had so far, which is remarkable?
And it's a fair question, but I'd also say that's a question that we've been hearing for years about, hey, you've gotten to this size, where will the growth come from here? And I think we've sort of proven ourselves on that front. But to answer your question, I would step back and say our firm has been around for 38 years. I've been fortunate enough somehow to be there for 26 of the 38 years. We have a very long-term view on building the business. We don't just want to be a very good asset management company. That's in addition to that, we want to build really one of the great companies in the world that is very enduring. That is Steve Schwarzman's vision, and it permeates our culture and everything we do. So I'd say that's the backdrop. And against that backdrop, there are some really profound secular tailwinds that continue to sort of power the future of our business. And it's both with respect to markets that we invest in and also the markets from which we raise money to invest. And so on the former, there's really an amazing long list of addressable market opportunities. I just tick off a few of them, globally in private credit, globally in the infrastructure area, in energy transition, which will require obviously trillions of dollars of capital, in the alternatives business in Asia, which is still earlier in its development, further development of the secondary market for alternatives generally, which is still underdeveloped, investing in the life sciences revolution where we have a big business. So there are some really big markets to invest in with a lot of runway that I think will create really, really big opportunity. And then on the fundraising side, the markets where we raise capital, structurally, the world's investors are still underallocated to alternatives. And so people focus on sort of traditional institutions, and there's still a lot of runway to go there. But then in other really, really big channels, like insurance, like individual investors around the world, they are really barely penetrated with respect to alternatives. And so there are a lot of tailwinds there. And we think we're the best positioned firm in the world to capture the opportunities. We like to think we're the reference institution, that we have the assets of our brand, our reputation, the scale of our platform, and really importantly, our culture. So we think we have created a culture that does both performance and innovation well. And if you had to ask me sort of what makes us special, I would say we've been able to combine being very good investors with being very good business builders and being able to institutionalize that. And that's unusual in the investment business. And that's what's powered our success to date. And that's what we think will propel our future.
Blackstone's Michael Che there, speaking with David Weston, host of Wall Street Week. And of course, you can catch Wall Street Week every Friday at 6 p.m. Eastern. All right, a check on your markets. We go without the U.S. today. Those cash markets are off for the 4th of July holiday. Futures are up and trading little changed. European equities are stronger, not being helped out by cyclical shares, I should say. We're looking at the DAX, for example. That is dragged lower. Things like automakers are underperforming. Aussie dollar, strength emanating through there. The big FX story, not just the pickup from oil for commodity currencies, but a hawkish hold from the RBA, kind of like the Fed. And then, yes, as I mentioned, we're finally seeing a rally in Brent crude. That is up nearly 2% off the back of cuts announced, continued unilateral cuts from Saudi, from Russia when it comes to oil exports. That's an important key when it comes to Russia. It's not just output, it is export. So we will see in the data whether that actually happens. Yesterday, oil fell off the back of that announcement. You'd expect it to rally, and today, indeed, it did rally just under $76 a barrel. All right, let's check in on the broader market story with Christine Aquino, Bloomberg News managing editor of Markets Today. Christine, I feel bad doing this because the U.S. is closed. There's no cash trading for the bond market, but I do want to talk about the 2s, 10s inversion. It's been 1 year since it inverted, the deepest since the 80s. What does that mean?
Oh, Danny, I mean,
the debate of whether it means a recession and whether it doesn't. I mean, I feel like that's really matured now, right? Because as you say, it has been a year since we've been in this inversion mode. I guess it is a bit of a milestone that it is the deepest inversion now since the 1980s. And yet, to me, really, it just shows how, in some ways, how broken the market is, you know, in terms of the short end really having to catch up with all those bets on higher rates. And because there was a time when markets weren't convinced that the Fed was going to keep going, right? And there was this narrative of a pause eventually turning into just a complete stop. Obviously, that's been dispelled. And so there's that dynamic going on there. And then on the longer end, too, just this idea that I think there's very much still this camp in the bond market believing that all of these rate hikes are going to amount to just slower economic growth, maybe even a recession. And that's really what we're seeing in the long end. So, you know, the broken market, I don't know how it's going to be fixed.
You know why I love this, Christine? Because the conversation about bonds versus stocks typically goes something like this. Equity investors, they want to be bulls, they'll buy any rally, they're living in la-la land, where the bond traders, they're the mediating bond traders, are more pessimistic, are more right. What you're laying out is a bond market that is playing catch up because it got it wrong. Going forward, how is the sentiment split in terms of what is correct now? A bond market that's still pricing in a recession, or an equity market that continues to defy gravity?
Well, Dana, I wish I could tell you there's consensus there, but there really isn't. I mean, even within the bond market, we have the likes of Morgan Stanley arguing against Bill Dudley, right, where the direction is going. Dudley, of course, arguing that there is more losses to be had in the bond market, but Morgan Stanley saying that, no, the hikes that we've seen will eventually feed into economic growth, slow that down, and then we'll see yields coming down here. And, you know, when it comes to kind of the interplay with stocks, I mean, even within the equity market itself, the debate is very much raging. Where are stocks going to go from here? Is the first half, the gains that we saw there, double-digit gains for most major markets, is that behind us now? Is the best of it now over? And are we now staring down a second half that's going to be a lot more subdued? A lot of it, of course, going to depend on the earnings season that's coming up and what the outlook really is for companies into the second half of this year.
Oh, you read my mind. That's exactly where I was going to go. What is the current consensus, if there is one, in terms of corporates, in terms of maintaining profit margins?
Well, look, let's get away from the consensus discussion.
Okay, yes,
because,
that's probably
wise.
It's
very difficult.
Just what makes the market, Christine.
Exactly, yes. But, you know, I think one
consensus, if there is one, in terms of corporates, in terms of maintaining profit margins.
Well, look, let's get away from the consensus discussion.
Okay, yes,
because,
that's probably
wise. It's very difficult.
Just what makes the market, Christine.
Exactly, yes. But, you know, I think one thing that there is consensus on is kind of what is going to be the main concern for investors, and that's really going to be the sense that we get from companies over their profit margins. You know, the first half really has been quite a surprise, a pleasant surprise in terms of companies' ability to deliver that pricing power, to pass on higher costs to their consumers. That's going to be a bit of a higher bar, I think, in the second half, just because, you know, consumers are starting to awaken to the fact that, oh, maybe there's greedflation at play here, and maybe they need to kind of push back against those higher costs. And there's also political pressure on companies as well. In the UK, of course, we're definitely seeing that. And so I think that's going to be one thing that you'd really want to pay attention to, because that would factor into kind of the future outlook for earnings growth as well. We're seeing, again, more downgrades rather than upgrades by one measure, according to Citigroup. And so, you know, there are worrying signs there, but the profit margin story, definitely one to keep an eye on.
Christine, thank you so much. Always a pleasure to speak with you. Bloomberg's Christine Aquino there. All right, as we close out the hour, we're still looking at an equity market rally in Europe, and coming up, coverage of these markets will continue with the U.S. offline futures are basically flat. We're going to be having a conversation coming up with Spanish Foreign Minister Jose Alvarez for you next on this 4th of July holiday. This is Bloomberg.
Can you believe it's summer already? That means it's time for the Boston Pops Fireworks Spectacular. And Bloomberg will make sure you see all the fireworks, music, and special appearances by pop superstars En Vogue, chart-topping country duo Low Cash, and film, TV, and Broadway powerhouse Mandy Gonzalez. Plus the U.S. Army Field Band and the cast of the Broadway musical Ragtime. It all starts tonight at 8 p.m. Eastern right here on Bloomberg Television and Radio.
From the world of politics politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
So it's Tuesday, it is the 4th of July. Welcome to Bloomberg Markets, I'm Guy Johnson. Let's talk about what you need to know about today. So first and foremost, no fireworks. Markets a little adrift today, light volume, the US is closed, 4th of July holiday. I have to say though, it is going to be a big week. Back end of the week, lots of data, US payrolls, obviously the crescendo. Ahead of Janet Yellen's trip to China this week, Beijing announcing export controls on some key metals that are critical to the tech sector. We'll talk about that in a moment. And shaky foundations. In the UK, the 5-year mortgage hits 6%. Housing stocks are under pressure. JP Morgan downgrading Persimmon. That's Britain's third biggest builder. We'll talk about the housing market here, plus the savings rate. Let's talk about the markets right now. It is quiet out there. The US is out, takes a chunk of volume out of the market. You can find this on your Bloomberg. Take a look at the AVAT function. So the stock 600 kind of drifting sideways a little bit right now. You do have some of the real estate stocks doing a little bit better. Sainsbury's is an interesting story. This is one of the UK's biggest grocers. It's talking about the fact that we are seeing an easing when it comes to food price inflation. However, the reason the stock is down, it has not upgraded its guidance. The market was looking for an upgrade. The comps are really easy right now for some of these grocers. The market's basically saying could have done better. And euro-dollar drifting. We need some more data. We had ISM yesterday. But as I say, there's some big numbers coming up later on this week. We're going to crescendo with the payroll number Friday. That's obviously going to be a big moment. This as we enter the second half of the year. Let's talk a little bit about the first half. Let's figure out kind of where we were. Maybe that'll tell us about where we're going. I want to show you this chart. So basically, this chart tells you a story. It tells you a story of the fact that Japan has done really well. Japan and technology have been the two real big outperformers in the first half of the year. That's the yellow line, that's the white line. Now, if you currency adjust Japan, it doesn't look quite so clever. If you put the equal weight S&P into this chart, it basically mirrors the blue line at the bottom, which is Europe. But basically the trend is this. If you've been in tech, you've done well. If you've been in Japan, currency adjusted, you've done well. But if you haven't, do you need to chase this market in the second half of the year? If you're a portfolio manager that is behind the fundamentals matter, do you need to chase the markets? Let's bring in Comerica Wealth Management CIO John Lynch, who joins us on the 4th. Nice to see you, John. Thanks for giving up your morning for us to talk to us about what's going to happen next. John, look, in the first half of the year, if you weren't in tech, if you weren't in Japan and certain other markets, you are probably behind on your benchmarks. What do I need to do now if I'm a portfolio manager? Do I need to get involved? Do I need to play catch up? Or do I wait for the market to come back to me?
Thank you, Guy. Good morning. I agree that if you look at tech and Japan outperforming year to date, and that gives me some caution, right? Because that's a market that shows me it's still dependent on low rates. The Bank of Japan has not raised rates in spite of 4% inflation. Technology, we're still discounting long duration earnings at the mentality of 0% on the short end of the curve. But as we all know, it's 5% on the short end of the curve. So I would not chase this rally. Specifically to your question, I think you should wait till the market comes back. That Europe chart, and as you said, the equal weighted S&P 500, I think that's more reflective of a market that's accurately pricing in flat earnings and the potential for a mild recession in the U.S.
When does that happen, John? This has been the key question. Everybody's been offside in the first half of the year. The fundamentals should have told us that we were heading for a slowdown, possibly a recession. That recession's been pushed out. The market, the stock market, has continued to rally.
Sure. Mañana means not today, right? Because we just don't know when this recession is going to occur. It's really hard. We're in a manufacturing recession. We saw that again this morning, right? We are in an earnings recession, but it's hard to have a true recession when everybody has a job. And I think that what's the Fed is trying to accomplish, and that's why today might be a slow day, but it's a very big week, because not only do we have the June payroll report, but the JOLTS report, I think, is going to be as not more important, because I think the Fed wants to attack job openings rather than jobs in and of themselves. And I think once you start to see that, and then second quarter earnings, this will be the second or third quarter of profit declines, and typically the playbook is businesses start to cut jobs and expenses thereafter.
Is that going to happen this quarter, though, John, or am I going to have to wait another quarter? I'm starting to see some companies withdrawing guidance. I'm starting to see some companies cutting, but it doesn't feel like a wave yet.
Right. I think the companies are going to start announcing it over the next 6 weeks, which could give the market some sort of comeuppance, pull back maybe. I don't think we test the October lows now that we're north of 4,400, but I do think the 200-day moving average on the S&P 500 at around 4,000 could be very important support. There's still so much liquidity out there. December of 19, M2 was what, 16.5 trillion. Now it's 20.5 trillion, even though the Fed's been raising rates for a year.
So do you think the liquidity question is really interesting? Liquidity is going to be withdrawn quite significantly in the second half of the year. Like I was always told, liquidity up, stock market's up. Liquidity down, stock market's down. Is it going to be that simple?
I'm afraid that's what your technology and Japan chart shows, right? And but I think when you look at the other 492 companies in the S&P 500, I think they've kind of accurately priced in. And I'm just not convinced when you see leadership from communication services, leadership from technology, and leadership from the tech-like names in consumer discretionary. I'm not sure that's fully reflective. And I think you're going to have to see something there before the market will test that 4,000 level, as I suggest.
John, what do I do? I'm sitting in cash and there's a lot of money in money market funds. Where do I look first? Do I look to lock in duration first, or do I look to get back into the stock market first?
I like 5% at the short end of the curve, right? That can make up for a lot of sins. There's been as many articles, many programs on the whole idea that 60-40 was dead. And I think the demise of the 60-40 portfolio was greatly exaggerated. And what you can do is, I think you should look at quality. I don't think you should go duration. I think we are inside of benchmark on duration, and we are high credit quality. And that's a good point that your investors should pay close attention to, because while the Treasury yield curve has been pointing to recession for over a year, there's not too much stress in the credit market. And what I mean by that is corporate credit spreads, whether the investment grade or high yield, are still well below their average band over the last 25 years. So treasuries are saying we're going to recession. Corporates are telling us it's not going to be that bad.
But what has been interesting in the first half, John, has been that high yield has outperformed IG. Does that flip on its head in the second half? Is that what you're saying?
Yes, and I think what the fascinating thing there is, high yield typically trades in line with small caps, yet small caps have been lagging. So I still think the high yield game had something to do more with the yield differential as opposed to the traditional correlation between high yield and small caps.
I understand why you would want to play it at the front end at the moment, John. You're getting a cracking yield. The curve is heavily inverted. But at some point, as you say, this economy is going to roll over. And when that happens, how do I know the point to get out of the short end and go a little bit longer? Because at some point, I'm going to have rollover issues. Yeah, when do I want to stretch out further down the curve?
I'm going to wait to see Powell the next couple of meetings. He's been very aggressive in his messaging, and the market's kind of ignored it. We had, you look at Fed Fund futures, we've taken 50 basis points in cuts off the table. We've added 50 basis points in additional hikes, and the S&P 500 is up 5 or 6% over that time period. So that's a market that's still dependent on the old playbook. So I am not going to flip to long duration until I get a really good sense that if we're at 5.5% on the Fed funds by year end, I want to make sure I have a good sense that Powell is done and going to hold through 24 or first half of 24. We need to see a couple more quarters of this.
So you think the cuts come potentially late next year at the earliest?
Late 24, you get a mild recession, you get a 50 basis point increase, say, in the unemployment rate. That's typically been the line in the sand when the economy slips into recession. We could have a mild one in the second half of this year, and obviously with the political climate in 2024, the pressure is going to be on him like he hasn't experienced yet.
Great to catch up. Enjoy the fireworks, John. Thanks for stopping by so early for us. We really appreciate it. Comerica Wealth Management's CIO, John Lynch, not co-CIO, CIO. Thank you very much indeed. Okay, coming up, China imposing export bans on metals needed to make chips in the United States. Details to follow. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Minutes past the hour, time for a chemistry lesson. You're watching Bloomberg Markets. Let's talk about some key metals. A little journey through the periodic table. China escalating the tech trade war with the United States and Europe. It's now restricting exports on two metals that are key to the semiconductor industry. Mark Burton joins us now, Bloomberg's Mark Burton. Mark, what are these metals and why are they so important?
Hi. So the two metals that impacted here are germanium and gallium, and these are tiny industrial metal markets, the production of which is born out of larger industrial metal waste streams, effectively. You mine zinc or bauxite, the core ingredient for aluminium, and you process that into those metals, and in the process you extract some of these minor metals, as they're known as well. Those are then sold in kind of unrefined forms to very specialist refining companies, the large majority of which are in China, and then they turn them into very pure metallic products that have very critical applications in things like satellite imaging and optical electronics and so on.
Why are the Chinese so dominant here?
So it's really about that industrial supply chain that has been built up. You can find gallium and germanium in small quantities all around the world, but China has really excelled in managing to turn a profit from extracting these materials from waste streams, turning them into very, very high purity products, and getting very close to end use customers in things like chip making, because it's a very exacting science, as you can imagine. You need these things to be incredibly pure, and the verification process, the certification process to sign up as a supplier to chip makers is a very arduous process, and you have to go through lots of R&D with them, and there are really just a handful of Chinese companies that have excelled at that in recent years. And
Mark, the United States has taken a big step forward in making sure that it does have security in its chips industry. The CHIPS Act, obviously, an example of that. If we do see restrictions, if we do see concerns around this, how quickly could America or others, how quickly could they turn this around and produce what they need?
In theory, you could have a relatively swift supply response. Zinc producers that produce zinc and germanium as byproducts in the past, when prices have spiked, they have boosted production. But getting to a commodity grade product is one thing, and if the price incentive is strong enough and the strategic support is there, then perhaps that happens. Then the second obstacle to overcome is developing that very high very kind of high purity refining circuit to get products that can actually be used by these very exacting customers, and that could take some while longer. There are a few alternative suppliers, but whether they have additional capacity to make up for China's loss is unknown, but it's unlikely that they can compensate for it in full.
And potentially it could become more expensive. Mark, great stuff. Thank you very much indeed. Bloomberg's Mark Burton on what is happening with these key metals. Let's turn from one commodity to another. OPEC Plus oil ministers and CEOs of big oil companies will be gathering in Vienna starting tomorrow for OPEC's annual international seminar. Joining us now for What to Watch, Bloomberg's Julian Lee. What should we be watching?
Very good question. I think that this is a public conference. This isn't a policy gathering. So we're not looking for OPEC Plus policy. We're not looking for any talk about output cuts or balancing the short-term market or anything like that. This is going to be a bunch of panels of academics and business leaders and OPEC plus ministers talking about the energy transition, cleaning up the process of extracting oil and gas, so reducing methane emissions and reducing energy use in the oil and gas fields. And I suspect talking a lot about the need for investment in oil production going forwards, because we haven't been doing enough of that.
Okay, let's talk about that need for investment. There was this whole idea in the second half of this year that we were going to see basically a squeeze, because there hasn't been enough investment, therefore we do not have enough capacity. Yet I'm seeing Saudi Arabia and Russia announcing fresh voluntary cuts, which tells me that they're not quite so convinced that the market's going to get tight in the second half of the year.
I think you're absolutely right. I mean, if you look back to the start of this year, everybody was forecasting that oil prices would be back in triple digits by the end of this year. The $100 a barrel forecasts were everywhere. You look now, you can find, I don't think you can find anybody who's forecasting $100 a barrel oil this year. People are now talking $80, $85 a barrel. And I think there's two parts to that. One of those parts is that although the Chinese economy has opened up from its sort of COVID restrictions, only about half of Chinese oil demand is related to transport. That compares with something like 80 or 90% in the West. And while transport has picked up, Chinese industry and Chinese construction hasn't in the same way. So it hasn't boosted oil demand as people thought it might do. And then on the supply side, Russian oil production has held up much more strongly than people thought. We've seen Iranian production going up, Venezuelan production going up. So there's more oil around than people had anticipated. That said, the forecasts are still for a tighter market in the second half of the year. If you look at either the International Energy Agency's forecasts or OPEC's, they're forecasting a shortfall, even before these additional Saudi and Russian cuts, of about 1.5 million barrels a day.
Let's get back to what you spoke about a moment ago. This is the kind of about the future of oil. This week I've seen BYD out with really strong numbers in terms of electric car sales, which continues. Tesla, really strong numbers. I've got negative power prices in Europe because Europe has installed significantly more solar than we anticipated, and we're actually having problems using all the electricity we're generating. Nice problem to have. What does that tell us about the rate at which we are going to walk away from hydrocarbons?
I think what it says is that, you know, the shift is inevitable. The shift is happening perhaps more quickly than the oil producers would like. I think that there is truth in the argument that the internal combustion engine is going to be with us for a long time to come. I mean, you know, you can have very high rates of penetration of electric vehicles into what is a huge car and truck fleet. That is going to take decades to really displace the sort of the rump of internal combustion engines, because you know those vehicles will get older, they'll get sold on, they'll
store base is still
you know there'll be countries that are continuing to use them. So that oil demand is going to be there. But I've been following the oil industry for longer than I care to admit in public. I can remember back in the 1990s at industry conference after industry conference, and there were two things that CEOs were continually worried about. One was the lack of new talent coming into the industry. We were failing to attract graduates into the oil and gas industry. We're going to have this huge staffing problem. And the second was that there simply wasn't enough money going into the exploration for and development of new oil fields. So this isn't a new concern. This has been there for at least 30 years.
I remember interviewing back then. A long time ago. Tells me
we
maybe
both have fewer grey hairs.
Well, yes, precisely. Julian, nice to see you. Thank you very much indeed. Julian Lee. Okay, still ahead. Credit Suisse bankers are dusting off their resumes as the UBS takeover continues. What do these changes mean? We're going to talk about the wealth management business next. This is Bloomberg.
you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
So a slow burn of a day. We're waiting the fireworks later. This is Bloomberg Markets. I'm Guy Johnson. Happy 4th of July. Let's talk about what is happening with Credit Suisse and UBS. Private bankers at CS Credit Suisse are being told to basically dust off their resumes ahead of the selection of a new group of managers. This, of course, follows the takeover by UBS. Let's talk about this with Bloomberg's Steve Aarons, joining us now from Frankfurt. Steve, wealth management, this is the side of the business that UBS presumably wants. So how differently is it being treated? Talk me through this story.
Well, you're right. I mean, the wealth management part is what makes Credit Suisse so attractive in the eyes of UBS. UBS itself is a huge wealth manager. They want to become even bigger. And so we've seen some departures in the Asian business in particular because of the uncertainty in Credit Suisse. And they're really trying to keep these people and make sure they get the best ones for the business where they want to grow. It's not easy. The competition is strong, but this now shows it's certainly going ahead, and they're making a big effort here.
Okay, I've seen a steady stream of headlines over the last few weeks, many of them brought to me by you, about quite high-profile departures from Credit Suisse. Why would anybody that is good, who has a good resume, who others are going to want, why would they still be there at this point?
I mean, it's a mix, I think, of several elements here. First of all, it's not always easy to find something else. Second of all, bonuses may be tied up, pay may be tied up. If you leave, some people tend to forfeit a whole lot of money. And of course, if you're actually a good wealth manager, and UBS is telling you, stay on, we're going to pay you a lot of money, you can make a career here, then maybe it's not even looking so bad, So I think there's a number of reasons why people are actually staying. Some people are staying.
Some people have left there because they can see the writing on the wall. How big are the job cuts going to be at Credit Suisse? Do we know yet the scale of it?
Well, yeah, it's going to be massive. I mean, we just reported last week that about half of the Credit Suisse jobs could be gone. I mean, it's going to be really massive. Much of it in Switzerland, probably, if they keep the Swiss unit. Much of it in the investment bank. Deutsche Bank put a research note out today saying they expect all of sales and trading at Credit Suisse to be wiped out. And much of the investment bank too. So yeah, for those people, it's not looking too great, to be honest.
Steve, great stuff as ever. Thank you very much indeed for bringing us the story. Bloomberg Steve Aarons. Coming up, we're going to get an update from France on the unrest that's been rocking the country in the last few days. What's the latest? We'll have it. This is Bloomberg.
does everybody want to be a consultant? And what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
News breaks. No one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already. History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone. Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Uh, 29 minutes past the hour, let's call it half past. Welcome back, you're watching Bloomberg Markets, I'm Guy Johnson. Let's turn our attention to what has been happening in France. President Emmanuel Macron meeting with more than 200 mayors to assess the damage that the riots have done over the last few days. They've been rocking France. The massive police deployment that we've seen has had an impact. We have seen a drop in the level of unrest overnight. Let's figure out what the latest is. Let's go to Paris. Our bureau chief there is Alan Katz. Alan, what is the latest? It looks like last night was quieter. Is that because the riots are beginning to fizzle out or because the police presence is having an impact?
It's probably a combination of both, but it has been getting progressively quieter as the days have gone on. We sort of hit a peak Thursday night and Friday night, and it really has been getting somewhat quieter ever since, particularly since Saturday night. And so there has been, as you mentioned, this massive police presence that's been out every night. There'll still be, again, a large police presence out tonight, but it has really been getting quieter. And at that meeting with the mayors that you mentioned that President Emmanuel Macron was having, he was a little bit careful in what he was saying. And he said, you need to be careful for the next few days and few weeks, but that probably, in his view as well, that the peak of these protests had passed.
Yeah. Alan, what's the plan for dealing with the root cause of what is happening here? What's happening with policing, what's happening with deprivation, all of these kinds of issues. Has this changed thinking within the government?
So that's a tough question, Guy. I mean, the answer is, so according to the Élysée, according to the president's office, they're going to take a deep look at the root causes of what's happened here and try to come up with some new responses, because there's no point in trying to essentially try to have the same response that they've had to previous episodes like this, specifically the one in 2005 when there were about 2 weeks of rioting that were somewhat similar. So they're going to try to come up with, really get a deep understanding of all of the issues here and try to come up with some serious responses, they say. As you point out, this has been going on for a very long time, and it's not just true in France, it's true in a lot of multi-ethnic countries, so finding solutions is really not a very easy task.
Absolutely, but how does this change the trajectory of this presidency? How does what's happened here change the trajectory of this presidency?
Well, that's another good question. I mean, the answer is one possible answer is Macron has faced a series of protests against government or authority figures throughout his so far 5+ years in office. He's had the yellow vests back before COVID. He had protests over a retirement form earlier this year, and he's had these protests, which are, which sparked at least by the police killing of a teenager in a suburban neighborhood. So each one taken separately, has an impact on the perception of the French government, on perception of Macron's ability to sort of navigate France through choppy waters. When you add them together, it does start to weigh on his administration as he seems to be buffeted by a series of crises that he is having a hard time getting in front of.
Yeah.
Whether this one has any sort of long-lasting impact is hard to tell yet. There was actually a relatively brief period. If these riots really don't come back, it will have been roughly a week, which is not an extremely extended period of time. That said, as I mentioned, it's the third sort of set of social crises that he's had, and that starts to become a pattern, which is a little bit difficult to brush aside.
Alan, great stuff. Thank you very much indeed for the update. Our bureau chief in Paris, Alan Katz. The next story that I'm going to bring you feels appropriate in light of what we've just been talking about. Back in the United States, French wine, all the rage, especially today. Everybody's celebrating the 4th of July. Demand is going to be high. But let's talk about a company that is coming at the wine industry from a different angle. Lafite Wine CEO, Donné Berson, joins us now to talk about what is happening in wine, but also what is happening in the opening up of wine. Great to see you, Donné. Thank you very much indeed for joining us. You set this company up, what, a year and a bit ago, Lafite? It is a black-owned, black-started wine business, and diversity is at the core of what you do. You've had a meteoric rise. Demand has been absolutely enormous. How important has that diversity been to the success that you've delivered over the last couple of years?
Well, good morning. First of all, thank you for having me. As you mentioned, this is the perfect time to talk about amazing French wines with Lafite Wine Company. Our growth over the last couple of years has been amazing, not only because of diversity, but also what's in the bottle. Our messaging from day one is Lafite's a party and everyone's invited, and we truly believe that because wine is a great connector, and with Lafite we personify that. We remove the stereotypes that were typically associated with wine in general to make it much more welcoming, much more gender agnostic. And it's about fun, and we feel like we're celebration in the bottle, and we think that messaging has been well received by consumers, which has contributed to our meteoric rise.
In terms of the demand that you are seeing, how big is it? What kind of this weekend is obviously going to be sorry, not this weekend. This 4th is going to be a big event. The consumer is back and back with a bang right now. How much demand for your product are you seeing? Are you able to satisfy all the demand that you have?
Absolutely. So year to date, we're up 82% versus last year. Despite price compression in the rosé category, we're still standing out and growing at a clip much larger than our competitors. In addition to that, we've also launched a fantastic white wine from Provence, Lafite du Blanc, which is indicative of what we're seeing in the market as a trend that interesting white wines from France are becoming all the rage. This is something we saw a couple years ago, and we believe we're at the forefront of that mission to bring great white wines from Provence, along with the rosé, to the United States.
Has the price point in rosé changed over the last few years? You go up to Draguignan, you see Whispering Angel, you see lots of other high-end wines, Chateau de Beaune, near Lorgues. These kinds of wines have raised the price point quite significantly over the last few years. Is that pricing power sustainable?
Well, we continue to see premiumization happening in wine, specifically where rosé and white wines have been the most resilient. We are seeing price compression in the category where every competitor is now priced between $1 and $3. We don't know if that will continue, but certainly with the acquisitions that LVMH is making across the region, that will have some fundamental effect on the pricing long term. It would either stabilize or would continue to go up. But also weather plays an important part of all of that. Over the last couple of years, we've had late freeze and fires, and all of that dictates what the pricing of grapes will be.
Provence obviously is where the great rosé comes from. Some may argue with me on this, but let's just kind of take that as a fact right now. You bring up the weather. I have to say, I've seen some really hot summers down there recently.
Yeah.
Is the climate change story going to alter where you ultimately think you are going to be producing?
Well, I think it has an effect on all of us, all of the producers in the region. What it really does, it puts a lot of strain on some of the most predominant grapes that are used in rosé, like a Grenache, which then makes the winemaker have to offset that lower production or lower yield on Grenache to produce the same style of wine for each house. We think we've done a great job of that over the last couple of years, but it certainly is some strain on the operation standpoint as well.
Now, there's some debate in my household as to whether or not rosé should be with ice or without ice. Where do you come down on this?
Well, listen, I mean, if you think about how it's consumed in the hot parts of the south of France, certainly in the summertime, there's little refrigeration. You're outside all day drinking rosé. It's okay. Put ice cubes in it. It's called la piscine, which is translates to the swimming pool. So it's traditionally how it is consumed in the south of France. So you win the debate, or your wife wins the debate if she says that's
no,
the way to
my
go.
wife wins the debate. Yeah, she wins the debate. That's pretty common. That's not an uncommon event. Is this year a good year? What's next year looking like? What are you thinking about? Kind of just talk me through how you see the wine story over the next 12 to 24 months.
As I said, we're up 82%, which is a testament to the juice in the bottle. We launched our Le Blanc, which is a white wine, and interesting whites and white blends from the south of France and Provence are on fire and on the next rage. We've seen what has happened with Sauvignon Blanc from Sancerre, and we certainly think that's going to happen with white wines from Provence. So we're betting big, not only on our rosé, but also on our Le Fête du Blanc, which is a blend of Roll and Viognier. So it should be good. We think Le Fête du Blanc is the next big thing. We are going to bring Provence whites and Saint-Tropez whites to the forefront.
Absolutely. Can't argue with that. Donny, great to see you. Thanks very much indeed for joining us. We really appreciate it. Good luck. Donny Burson, Lafette Wine, CEO. Thank you very much. Okay, coming up, UK Prime Minister Rishi Sunak is facing questions on the UK's cost of living crisis. He's also talking about Thames Water. He's at a hearing today. We are going, in fact, he's speaking right now at the Select Committee hearing. We will be bringing you an interview as well with former UK Business Secretary Vince Cable next. This is Bloomberg.
Covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
The top names in business are on Bloomberg.
For Indigo, this is a 500 planes order. That's the biggest order ever in terms of number of planes. It doesn't change the short-term perspective on ramping up the production.
All our aircraft deliveries are delayed. The supply chain that was really decimated
during COVID.
It's a real challenge for all the OEMs at the moment, but we absolutely have to have those aircraft delivered on time.
Nobody covers business like Bloomberg, your global business authority.
Okay, I want to take you down to Parliament, to Westminster. That, of course, is Rishi Sunak. He, of course, is the British Prime Minister. He is giving evidence today to the Liaison Committee. What is the Liaison Committee? It's basically the chairs of all of the select committees, basically down at Westminster, coming together to speak to the Prime Minister, to ask him questions. Let me just give you a flavour of what he's been talking about on the inflation front. The Bank of England, according to Rishi Sunak, has, quote, a very strong record on inflation. I'm not sure the market would agree with that. Sunak says he supports the Bank of England on tackling inflation. He also says that the government will use monetary and fiscal policy fully on inflation. Again, questions around that. And Sunak, well, we'll get the latest headline and we'll bring it to you in just a moment. But these are live pictures coming to you from Westminster, where the Prime Minister is being asked questions and providing interesting answers. Let's talk about the kind of the upshot of this inflation story here in the UK and the challenges that the Bank of England is facing. One of the most interesting articles I've read this morning on the Bloomberg Terminal relates to the problems you have if you are the Bank of England in transmitting policy effectively to the real economy. Now, in theory, you raise interest rates and that hits demand. That is normally how traditionally these things are meant to work. The problem is that in the UK, there are significant numbers of people who have no mortgage and lots of savings. So you raise interest rates and they benefit from those savings and therefore spend more. And a lot of people are on fixed rate mortgages, so aren't feeling the effects of the monetary policy increases thus far. Now, the latter probably will change. The question is just the former. And actually, by raising interest rates, are you in a weird and slightly counterintuitive way driving demand, which is ultimately not what the Bank of England is looking for here. So let's get into this conversation. Philip Aldrich co-authored that piece this morning. First piece I read on the train this morning. Thank you very much. This is weird. This is not how this is meant to work. But in this country, we have enough people that have enough savings post-pandemic and enough people that don't have mortgages that net, actually, savers are getting more. The benefit to savers is greater, quite significantly greater, than those that are being hit by mortgage rises.
Yeah, so it's mostly, actually, it was partly to do with the fact that you've got a lot of owner-occupied houses with no mortgages, but also it's to do with the fact that there are so many fixed-rate mortgages. So 85% of the stock is fixed rate, so it rolls off only gradually. So the rate rises on the mortgage stock are coming through in a very delayed fashion. Meanwhile, the interest rate rises, which are not as large on the savings account, but that goes through onto the entire stock of savings relatively quickly. Yeah. And I mean, there are different measures of savings. There's time deposits or instant access deposits. It's not really been going on the instant access side of things, but the time deposits, so the stuff which people are hanging on to and really trying to make their money, get income from, that has been seeing a big increase. And so far, the increase in the income on the savings stock is been higher than the hit.
How much bigger?
It's about, so in the last year, since the bank started raising interest rates in November, 2020, December 2021, there's been a sort of net gain of about £10 billion in terms of, if you just narrowly measure the wealth of the UK of income from savings against the cost of your mortgage debt. So in that particular sort of tight measure, which is really, as you say, is where the Bank of England is trying to operate, there's a 10 billion gain for savers there net.
And does that in some ways explain the consumer confidence that we're seeing and the spending numbers that we're seeing? Is there a line that I can draw between?
Yeah, so I mean that's the bizarre thing. So we've been talking about the mortgage crisis and the mortgage shock. Yeah. And June was when it hit, and the GfK measures of consumer confidence in the UK, and particularly the sub-measure of personal, what you think is your personal financial condition, those have improved. And perhaps it's because of the survey contingent, a lot of people are actually seeing their income rising on their savings accounts. So
and presumably this will start to unwind because, as you say, the huge number of fixes are incrementally going to roll off.
This is one of the problems which the Bank of England talks about, and Bailey, the governor, has said, there is a sort of delay to the transmission mechanism because of the fixed rate mortgages. Now, we've thought of that as the impact of interest rate rises on the fixed rate mortgages is coming through more slowly because they're rolling off at about 7% of the stock every few months. This is a sort of looking at it from the other perspective, which actually it's worse than just rolling off slowly. The impact on savings is actually increasing. So the net wealth or the net income of households through the interest rate mechanism is boosted effectively for now. Next year, but sort of by the second half of next year, I think we're going to see the reverse happening. But it's about this delayed transmission mechanism again. So how do you have to raise rates even higher? What do you have to do to get on top of inflation? If your normal monetary tool is slightly blunted in this way.
So the Bank of England
It's a question at the moment rather than a definitive answer. But it's definitely one of the issues they've got to.
I look forward to you asking that question to the governor at the next press conference. Philip, thank you very much indeed. Philip Aldrich. Let's continue our conversation around what is happening in the UK. Earlier, we spoke with Vince Cable, former Liberal Democrat leader and current visiting professor at the London School of Economics. He says strengthening of regulatory functions in the UK is needed to avoid a potential collapse of companies such as the one we're seeing around Thames Water right now. This is what he had to say.
If the investors are willing to put in more cash, then that at least temporarily solves the problem. Of course, Thames Water isn't the only water company in trouble, but a capital raise from the government's point of view is by far the best option, though there will be painful conditions. I mean, I would imagine that the investors are expecting to see prices rise to ensure that there's an adequate return in future. But if the capital raise falls through, then the government is forced back into public ownership, because you can't just allow a water company to collapse. It's a fundamental service. And if that happens, of course, all the liabilities of the company go onto the public sector balance sheet, which in the UK are worrying. We're already 100% debt to GDP. So I think if the government can avoid nationalisation, it will, and will presumably have to make some concessions to the investors to stop that happening.
Yeah. How would you expect this to develop politically, Vince? There does seem to be some pressure from parts of the Labour Party, obviously not your political affiliation, but I'm interested in your assessment. Some Labour MPs calling on the opposition leader to reintroduce policies around renationalisation of water. Would you expect to see that?
Well, there may be calls for it, but I mean, the problem of actually how you handle public debt, which of course was the whole reason behind privatisation in the first place, was to try to get these big utilities off the public sector balance sheet. It remains a big problem, but politically there's a lot of anger around. I mean, after all, these water companies have failed to deliver some essential public goods. We've got this problem of overflow of sewage because of underinvestment in the sewage system. There's a lot of leakage. I mean, the real anger is essentially about things in the past. I mean, it's the way Macquarie took advantage of lax regulation to pay out very large dividends that were completely unjustified in terms of a fairly safe utility. I mean, that anger is there, but of course it's happened in the past. We can't retrieve the past, but the politics is quite toxic for the government.
Right, and so do you think that the sector has, I mean, some people have argued that the sector has a private equity problem, not a private ownership problem. From what you've been saying and the strains that renationalisation would put on the public purse, you might agree with that view.
Well, I think where this is heading is to a tougher regulatory regime. I think the problem is not a problem of privatisation, but more a problem of very weak regulatory operations. The regulators in some cases have been captured by the industry. You know, regulators went off to work for the private companies at much higher salaries. The regulation has been applied very flexibly. A lot of things have not enforced, and I think the pressure will now be on to have a tougher regulatory regime. Now, how you reconcile that with trying to get in more private capital to make up the deficits of investment is a tricky one, and the obvious logic is to move to higher prices, which in turn is very difficult in the middle of a cost of living crisis.
What do you make of the sort of complex structures that seem to exist in some parts of the utility space in the UK, Vince? I'm talking here about layers and layers between operating and holding companies, parts of the company, or many parts of companies issuing debt. This was the situation at Thames Water. Some parts of the company relying on dividends from other parts, domiciled parts of the business in Luxembourg, Cayman Islands. Is there a place for these kind of complex structures in what were previously public utilities?
Yes, well, this is, of course, not just an issue for the water industry, but this is a phenomenon we've seen, and that was essentially how Macquarie, who in a way are somewhat the villains of this story, took advantage of Thames Water, were able to extract very, very large dividends, which were simply not justified. I mean, this is a low-risk utility, after all.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
If you are looking for fireworks this 4th of July, I suggest you do not look towards the financial markets. US markets are closed. It is the 4th of July. That means very light volumes. Elsewhere, we're basically going to have to wait, I think, until at least tomorrow, but probably later on in the week when we get into some of the big data points. We're waiting for jolts. We are certainly waiting for the payroll report Friday to give us a sense of clarity and direction, maybe, as we really kick off the second half. Stock 600, as a result of which, fairly flat today. We're up by 0.2%. You are seeing real estate stocks doing a little bit better today. Sainsbury's is an interesting stock. Didn't raise guidance. The market wanted that, didn't get it from the UK grocer. There's an interesting take on this story, which we'll talk about maybe not next hour, the hour after that. These businesses are working capital businesses. You get 5% in the bank right now. Just think about that. Euro dollar doing nothing. In the next hour, we're going to be joined by BlackRock Fundamental Equities EMEA CIO Helen Jewell for her take on these markets. That's next. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
So it's Tuesday, the 4th of July. This is Bloomberg Markets. I'm Guy Johnson. Let's talk about what you need to know. There will be fireworks later, but there aren't many in financial markets today. We're a little adrift. Light volume, the US is closed. As I say, 4th of July holiday. That said, we are setting up for a really big week, which is going to crescendo Friday with the US payrolls number. Now, ahead of Janet Yellen's trip to China this week, Beijing has announced export controls on some key metals critical to the tech sector. We're going to talk about that. And taking on Twitter, Instagram's Threads looks set to launch, we think, Thursday. This, as Meta looks to take advantage of Twitter's troubles. So let's talk about where we are with the markets. As I say, we are seeing quite light volume. The US is out. This is normal. Low volume days, though, can produce interest. Thus far, we haven't really seen any, but the markets are certainly starting the second half on cautious tone, with a cautious tone. I want to talk about what the second half of the year is going to bring. So let's talk about that. This is an interesting chart, which we built earlier on this week, and I think just kind of encapsulates some of the trends that we've seen, particularly in equity markets so far this year. So the bottom line at the bottom down there is the stock 600. It's done okay. We're up by 8.7%. But look at the yellow line and look at the white line, and this is where the real outperformance has come through in equities in the first half of the year. The white line is the Nikkei. This is the Japanese stock story that we've been watching so carefully. Now, yes, you currency adjust that. It doesn't look quite so clever. The NASDAQ obviously has had an absolutely incredible run. So you've needed to be in Japan and you've needed to be in tech to outperform so far this year. If you put the equal weight S&P in, it would be basically down here where the blue line is, i.e. a comparable performance to the stock 600. But you want to outperform as a portfolio manager, don't you? If you haven't done that, do you now need to chase this market? That is a key question that I think a lot of portfolio managers will be asking themselves as they work through the 4th of July holiday. So let's figure out what is going to happen in the second half of the year. Do you chase the rally? Do you wait for it to come back to you? Helen Jewell, BlackRock Fundamental Equities EMEA CIO, joins us now on set. Nice to see you.
Lovely to see you, Guy. Thank you for having me.
It's a great pleasure. So if you weren't in tech, if you weren't in Japan, you probably are potentially behind your benchmark this year, if you have a global mandate. Those markets have done very well. The NASDAQ in particular has had a scorching first half. Does that continue in the second half?
Yeah, I think there's a little bit further to go, but really the key thing to remember, particularly in those tech names, is that it's been driven by earnings. And you're absolutely right. If you had a global benchmark, or of course a US benchmark, those tech stocks were absolutely critical. But in a European benchmark, there was a little bit more breadth to where that earnings rally was coming from. We saw it in luxury goods, we saw it in part of the industrial space as well, and of course we did see it in semis and the tech space. But it has been earnings driven. So the second half of the year, all eyes are on earnings and that dispersion of earnings.
Do you think earnings will hold up? I'm starting to see companies withdrawing guidance. I'm starting to see companies downgrading their earnings guidance. Is the next earnings season where that's going to turn from a trickle into a flood, or am I going to have to wait another quarter for that really to come through?
I mean, it always feels a little bit early to say the next earnings season is the big one. I was saying it at the start of the year, and I was actually wrong. We all were. Exactly 60% of companies outperformed expectations in that first quarter. But what I do think we need to remember is consensus earnings are pretty much flat. From a global perspective, it's just over 0%. In Europe, it's about 2.5–3% for earnings consensus. But it's that dispersion in the sectors. So if you look on a sector basis, some of those sectors are plus 20%. Technology, financials, very, very strong expectations. And some of them in the energy space, the material space, into negative numbers. So it's that dispersion. I think to just look on average is not going to be where this is about. It's about the sectors and actually for the second half of the year, even more the granularity within those sectors to really understand where the returns are coming.
The problem is that the first half of the year has taught us anything is that these markets have taken off in directions that we haven't really expected. The more granular you get, the more difficult it is to deal with those switchback changes of direction that we've seen.
I'm not sure I would necessarily agree with that. I mean, you say a bit of it has been unexpected, but what have we seen? We've seen high-quality companies with resilient earnings being those companies that are outperforming. Is that really so unexpected? Not really. What has
Are you
been
where we expected to be at the halfway point?
No. I mean, I must admit, I didn't anticipate the market's being quite so resilient at this halfway point. I was a little bit more bearish at the start of the year.
So does that mean so as you enter the second half, how is that changing your thinking? Should it change your thinking?
I mean, it probably should change my thinking. We all must learn from kind of what we thought at the start of the year and when we're going to be in the second half of the year. But from my perspective, what has not changed, what I'm absolutely fixated on now, even more so than I was at the start of the year, is the importance of really understanding where those earnings numbers are coming through and coming from. And the benefit of having that expertise to really understand not just what AI means, but truly through the whole supply chain, which companies benefit. And as a stock picker, as an active stock picker, honestly, Guy, it gets me so excited.
Okay, I hear what you're saying, but at some point in particularly equity markets, fundamentals you think would matter but don't, because positioning is so important. And I ask the question because a lot of fund managers may be behind their benchmarks and may have to chase the market. So I'm wondering whether or not the current trends carry on for longer simply because people have to play catch up. Fundamentals don't always dictate where market goes. They should go over there, but they often go over there.
Yeah, I mean, in the long run, I would say fundamentals always come through. I think we probably agree with that in the long run. In the short run, of course, there is a little bit of the FOMO factor going on, particularly with those US names. If you were more defensively positioned, as you said at the start, earlier on this year, anything with a beta of less than 1, even if all your stock picks were correct, you're probably still at best flat, maybe a nudge above, more likely underperforming. And of course that is preying on people's minds. But I think right now is probably not the right time to pivot, even if that is on your mind. I think where we are now is that feeling that even more so, we had obviously last week, Bank of England, interest rates continuing to shift upwards, or a few weeks ago. On Friday, as you mentioned as well, big numbers coming in the US, important numbers coming in the US. I don't think a complete repivot is the right thing to do right now if you've made it this far.
Yeah, okay. Which sectors have easy comps going into the next earnings season?
That's a great question because the simple answer is nowhere now. Now, at the start of the year, there were some very easy places. Europe felt relatively cheap versus the US. I think the European retail banking sector looked relatively underpriced versus everything pretty much. And those very easy comps have kind of disappeared now. They've not completely gone. I still think Europe has further to go. I still think the banks have got a little bit further to go as well. But the very easy pickings have certainly disappeared. What this is about is probably taking it to that next tier down. So, for example, in healthcare, those kind of big pharma names, the defensive names, they're still very interesting, but the valuations are not as compelling. But there's still some very interesting places in some of the biotech names that have pulled back, or indeed in some of the medtech names as well, which are seeing a little bit of a COVID delay of demand coming through.
We were talking earlier on the show about the fact that high savings rates are, with high interest rates, are giving people a lot of spending power. And I'm wondering if I can apply the same thing to companies. If companies have high cash generation, and look at a retailer, Sainsbury's may be a good example today. It's a working capital business, right? You can park money at the moment and get a really high rate of return. And I'm wondering how the rate story is now overlaying the corporate story, and how I think CFOs are going to be running their businesses for that cash pickup. I'm wondering, is there an opportunity to think about businesses through that lens of higher rates and how it affects their ability to use their money more effectively?
I mean, we always need to be very cognizant of the decisions that the CFOs are having to make. But it's really interesting, actually, Guy. When we speak with corporates, we're not necessarily seeing as much of that come through as I would have expected. I mean, the corporates are still incredibly bullish. I mean, you might say, well, they always are, but they are very bullish in terms of the consumer story. They're still very bullish in terms of capital expenditure. They're still very bullish in terms of their own positioning. So I can see that maybe that's something we have to be very focused on, keep our eye on, but it's not something I would say that we're necessarily seeing coming through at the moment.
Be interested to see whether we do.
I think so.
Be great to see you. Thank you very much for stopping by. Really appreciate it. Helen Jewell, BlackRock Fundamental Equities EMEA CIO. Thank you very much indeed. Coming up, China imposing export bans on metals needed to make chips. We'll have details of which metals and why they matter. That's next. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Minutes past the hour. Let's call it nearly 12 minutes past the hour. Welcome back. You're watching Bloomberg Markets. It is, of course, the 4th of July. light volumes in financial markets gives us a great opportunity to talk about some of the stories that I think will have a lasting effect. Let's talk about one of those now. China escalating the trade war with the United States and Europe. It's now restricting exports on two metals that are absolutely critical to the semiconductor industry, to the satellite industry. These are things that at the moment are only really produced in China. Bloomberg's Mark Burton joins us now for details. Mark, we talked about this a lot in the last hour. Just very quickly, just remind us of which metals we're talking about and why they're so important.
Hi. So the two metals are gallium and germanium, and they belong to a kind of loose category of elements known as minor metals, all of which tend to have very kind of specific, highly desirable properties that make them kind of indispensable in a lot of advanced electronics and military applications and so on. And that's why this is quite a major cause for concern. While these are very small industries and markets, they have an outsized impact and importance in certain strategic applications in things like thermal imaging cameras, in satellites, in solar cells, and in integrated circuits. So it's a very precise tool that China are using here to try to exert some leverage.
So these are critical. These are strategically critical. Let's call them strategically critical. The US therefore is going to have to respond. How does the US respond? And ultimately, will this, in the long term, basically force the US to make this stuff domestically?
So there were two broad routes. So one is that they go back to the rare earths playbook, where they did effectively, China did the same thing effectively, blocking exports of rare earths, and that was challenged by Japan and the US and the EU in the World Trade Organization, and Japan, with this latest measure, has indicated that it will review it for any kind of unfair trade implications. That's one channel, potentially a bit of a non-starter. And then the other one, in terms of actually trying to boost supply, is to try to seek out new sources of these metals in a refined form. The comfort that the US and Europe might have is that these metals exist in abundance in geographically kind of dispersed concentrations in ore bodies all around the world, typically in zinc and bauxite ores. But the problem is going to be extracting those metals from those raw ores in an economic fashion and producing them to a spec that is suitable for all of these very demanding customers in critical industries and
I wonder how price sensitive they are in reality. Mark, thank you very much indeed. Bloomberg's Mark Burton on what is happening with these metals. Let's turn to another commodity. OPEC Plus, oil ministers, CEOs of big oil companies, interested parties will be gathering in Vienna starting tomorrow for OPEC's biannual international seminar. Joining us now for what we're going to be watching come out of this, Bloomberg's Julian Lee. Julian, I asked you what we're going to be watching. Who are you going to be watching? I asked you that. What? Let me ask you in this hour, who you're going to be watching?
Well, partly it's going to be a question of who we can watch, because Bloomberg, along with several other agencies, has been uninvited from the event. We were initially allowed to register. We were given access codes.
So you were planning to go?
I was planning to go. I've decided not to under the circumstances. Our reporting team are already in Vienna. We were uninvited a week ago, so we don't have access to the room. But my colleagues have shown their dedication and their skills in getting people to talk to them outside of these events, and they will continue to do that. So, the people we will be watching, I think, are obviously the oil ministers of the big OPEC countries for anything that they might say about short-term policy, although I don't actually expect a lot of real news to come out of that. I mean, I think there will be a reiteration of we're acting to balance the market. I don't expect any policy decisions from OPEC Plus from this.
What message would they like to come out of it? What message would OPEC like to be generated?
I think that the message they want to generate is something that they've been talking about for a long time, which is the need for investment in oil and gas exploration and extraction, because energy transition notwithstanding, the world is going to continue to need oil and gas for decades to come, and without that investment, they are saying that there will be supply squeezes, and they can't be expected to manage the market on their own. I mean, they've attacked some of the ideas around energy transition, the way the transition is being conducted, and particularly the sort of anti-oil lobby. And, you know, to some extent, they have a point. The way to tackle transition is not to stop people producing oil, it's to stop people wanting or needing to use it.
Yeah.
And if you know...
Tackle the demand, not the supply.
Absolutely. And if you take away the demand, the supply will fall. If you take away the supply without reducing the demand, all you do is create shortage and higher prices.
Is it natural for OPEC to look east now, as its biggest customers increasingly are there?
Yes, I think so, and I think it has been for, you know, arguably for the last 2 decades and maybe more. But particularly, you know, with the US shale boom, the opening up of places like Brazil, Guyana, the OPEC world has very firmly shifted to the east with the rise.
So does China have an influence at this? We're about... I suspect we're going to see a lot of Western analysts. We're going to see a lot of people from the US and Europe turning up to this event. How many Chinese delegates? How many Chinese delegates will be there?
I think probably relatively few. You know, this does tend to be very much or an Atlantic basin kind of forum. If you look at the speakers, they're Western trading companies, Western oil companies, plus, you know, the African members of OPEC, the Middle Eastern members of OPEC, but still the Asian companies are, you know, there are representatives there, but relatively fewer of them. And there's an argument that says, you know, I know OPEC's headquarters is in Vienna, but there is an argument that says if they really want to bring in, you know, their core partners in terms of their core market, they oughtn't be holding this event in Europe. They ought to be holding it in Singapore or maybe even Dubai or you know, somewhere further to the east.
Julian, great to see you. Thank you very much indeed for stopping by once again. Bloomberg's Julian Lee. Let's talk tech next. Mark Zuckerberg preparing to roll out his Twitter alternative. It's called Threads. Could come out on Thursday. More on the new social platform that's on the way potentially this week. That's next. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Be a
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Big week this week for the social media landscape. It is official. The Instagram app, which we think is going to be called Threads, has now appeared on the App Store, the Apple Store. It's available for pre-order. This is the latest app from Meta. It's basically designed to compete with Twitter. Will it? What does it need to do to effectively compete with Twitter? Will the user experience be better? How's it going to work with Instagram? Many, many questions that need to be answered. Let's get some answers. Bloomberg's Alex Webb joins us now for more. Alex, is this going to hoover up disaffected Twitter users? Is that the objective here?
That's certainly the objective. It's hard to see how effective, or firstly hard to predict how effective it will be without having played with it, without seeing the functionality. You've got to bear in mind, it took Twitter, 16 years to get to the point it is today, although there's been a rapid acceleration in changes over the past year or so. Look, Facebook, Meta, it might as well try, right? It's got, despite all of its spending on the metaverse, it still has plenty of money to play with. And this isn't the sort of thing that's costing it tens of billions or something. It's relatively low risk. You might as well give it a shot. And if you get a few disaffected Twitter users around the edges, then as Mark Zuckerberg or as a Meta investor, you're probably quite happy.
If I'm an advertiser, how will I be viewing this?
You'll hope that the Threads setup will be a safer place for you to operate than Twitter is, where you've seen a rise in sort of adult content, some other more problematic content, which as an advertiser, you don't want to see your ads appear next to that stuff. So you would probably hope that Threads is a safer place to ad. Meta is also far better at measuring the effectiveness of ads because it has a way better sense of who is on the end of any given account. It's got far better deterministic data, as it's known, which means then it can target ads a lot more effectively. Twitter tends to be sort of brand advertising. It's not particularly sophisticated. They have a vague sense of who you are, usually. I mean, there are a lot of accounts that don't go anywhere near their real name. They can only guess what they're interested in by the nature of the accounts they follow. So it's quite broad stroke. That's sometimes quite good if you're a consumer because it means that you don't feel it's necessarily being too invasive with the way it uses your data. Meta clearly has a very experienced, very well-oiled advertising machine, and that's what they'll be looking to make the most of.
If I'm a verified account, what am I thinking here? How is verification going to work? What is the objective of verification? How should I be thinking about this if I paid for a blue tick?
It'll be really interesting to see actually how they do the verification piece because one thing is worth noting, this is called Threads, an Instagram product. It's not called a Meta product or a Facebook product. Instagram is the sort of friendliest, shiniest of the Meta app lineup. Instagram has a paid verification system very similar to the one that Elon Musk has pioneered at Twitter. That isn't the same as the old blue chip world, where I had a blue tick because I'm a Bloomberg journalist, and they want to ensure that there's not problematic information going out for people pretending to be a Bloomberg journalist. So we don't quite know how that's going to work in the new world. I suspect if it's tied to your Instagram account, it'll be pay to play rather than these are people that you really need to be caring about.
Great stuff, Alex. Thank you very much indeed. Bloomberg's Alex Webb. Coming up, we're going to look at what's happening with the travel story as we enjoy the 4th of July. That's next. This is Bloomberg.
politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news
This is such an important economic issue. He's no longer trying to run away from
That
it.
really blew some minds.
insight,
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
and analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
So it is a very long weekend in the United States. It, as a result, is a very, very strong period for the travel industry. Basically started Friday, kind of finishes tonight. JetBlue has been raising questions about US air traffic control actions. We've seen United talking about a similar thing. Robin Hayes and Mr. Kirby basically pointing the finger at what is happening with the travel story over critical periods like this. Basically, the FAA isn't fully staffed, ATC is not fully staffed, and therefore any problems show up pretty quickly. But the bigger picture, which I think both of those two gentlemen are driving at, is that demand for travel is super strong right now. Will it continue to be so? This is a useful indication, a useful litmus test this weekend as to what is happening. Benny Campbell leads the team covering global aviation. He joins me now. Benny, we know this summer is going to be busy. The 4th of July looks like it's been a really busy weekend. How much longer can this carry on for?
Well, it looks like the summer is in the bag in terms of travel. People have booked quite robustly going into sort of the summer and the latter part of the year, as you said. So that looks fine. And the question really is, can the airlines, can the ground people cope with this? We already saw, heading into this long weekend, that there were some glitches at the likes of United and other airlines. So that didn't go particularly well. It wasn't quite the mass breakdown that we saw last year across the globe, particularly here in Europe, but it was a warning sign to many. And as you said, there's a lot of finger pointing. Who's really to blame? The airlines say that they've done their homework, that they've hired people, but they're to some degree at the mercy of what's going on the ground. Are there enough security people? Is there enough baggage handlers? That's where the crunch point will be.
Okay, so where are the pain points? Is it still, is my bag going to show up? Do I need to go out and buy an AirTag or whatever a similar product is to put into my suitcase to make sure that I at least know where it is at any given point in time? Is it problems with ATC and the FAA? Like, it's not just the FAA, you've also got problems in France, obviously, with strikes. Where are the real bottlenecks still?
Well, I would say the answer is all of the above. Yeah, so you're going to have a lot of issues still in terms of strikes. We're not out of the woods in Germany. Lufthansa is still in negotiation with the pilots. That could go either way. It looks as if they've got it sorted, but you never know. You've mentioned France. You see the strikes flaring up there. We only heard from Ryanair this morning that they cancelled 900 flights in June. That's a pretty high number heading into the summer, so that's a warning sign. The ground controls aren't where they should be. So it's really all of the above that could really still create quite a few issues into the summer.
But we also heard from Ryanair telling us, was it 95% yield? They are not yield. They are basically sold out and as a result of which, price pressure is absolutely enormous. So are we going to continue to see these high price points, and is that going to be something post the summer that we're going to have to continue to deal with as well?
Probably yes. We're sort of at peak price at the moment, and you see it creeping into the ticket. The way the tickets are structured, they're asking for extras on everything from the way you check in your bag to where you sit. And because the flights are so full, every time there is a cancellation, there's a huge knock-on effect because an airline won't be able to rebook the people onto the next plane quickly. We saw it in the US that people sometimes had to wait 2 or 3 days to get onto the next plane. So the fuller the plane, the greater the risk of sort of mass carnage.
Load factor. That was what I was looking for, load factor. Benny, great stuff. Thank you very much indeed. Can't believe that left my head. Benedict Camel, great stuff. Let's carry on the conversation and continue to what is happening with the hotel business in the United States. Best Western Hotels President and CEO Larry Kukulik joins us now. Larry, how big is it going to be? What kind of a weekend are you having? What kind of a long weekend are you having?
First, thank you for the invitation. Happy 4th of July to everyone. Hope they have a safe, happy holiday season. Best Western is having a terrific summer season. You know, we came out of the first quarter and PwC reports a 13% ADR and RevPAR increase over 2019. And that was kind of the setup for the summer, that first strong quarter. As a result, you know, AAA is estimating that 50.7 million Americans are going to be traveling this summer, which is up 3.7% from 2019 and up 4.3% from last year. And so this is a tremendously strong demand period. And what also I think is important to note is it is a 4 or almost a 5-day weekend, which really positively impacts occupancy at our hotels.
So demand is strong. Is supply keeping up?
Yes, supply is keeping up in the hotel industry. But keep in mind, demand and occupancy drive rate. And that's one of the parts of the equation which are resulting in us having a tremendously strong 2023 summer season.
And do you expect that to continue? There's evidence, Larry, that consumers in the United States are maybe working their way through their pandemic savings, and we could be getting to a point fairly soon where those savings run out. Is this as good as it gets?
Our forward bookings are on par with 2022. You still have that demand for travel coming out of the pandemic, and you've got gas prices that are down, I think, $1 a gallon versus last year, and inflation and interest rates, I'll use this term, have somewhat stabilized. And as a result, I think that's the positive momentum that we hope to continue into the September, October, November time periods.
But I'm assuming that that's where your visibility gets a little fuzzy.
No, our forward bookings, because we do, of course, track forward bookings, are on par with what we saw in 2022, which was that strong pent-up summer demand season that extended into the fall.
Okay. In terms of what is happening with labor availability, the stuff that you need, are we starting to see an easing in the inflation rates that you have experienced post-pandemic?
Well, there's always a demand for labor. You know, demand for rooms creates demand for labor. As you were just commenting with your previous guest with regard to the aviation industry, labor will always be something you have to monitor and manage very closely, because of course we want to make sure we're exceeding guest expectations when they travel and stay at Best Western hotels. So you've got to manage closely your labor as it relates to occupancy.
Okay, so how are you doing with that? Are you having to pay more than you anticipated, Larry? Do you think you're going to carry on having to pay more than anticipated? How easy is it to attract staff right now? Just give me a sense of kind of what the real picture is. We've got the employment number coming out on Friday. What does the employment report look like at Best Western?
At Best Western, we're very fortunate. We have a culture that believes in teamwork, collaboration, the spirit of people working together. And that's what you have to do. To me, and what we tell our hoteliers, it's not about hiring talent, which is always in demand. It's about retaining retaining talent. And if you build that culture, and we have so many of our hoteliers that are, I'll call it independent, small business owners that make a difference in their community. Yep. That's what allows them to keep pace with regard to labor challenges.
What does the United States look like compared with the rest of the world?
In terms of labor challenges, sir?
No, just in terms of demand more broadly.
Demand, well, again, we're looking at being up 4 to 5% year over year. Who's really going to have a terrific and is having a terrific summer is Europe. Alliance Partners recently reported, I think, a 55% increase in bookings to Europe, with top destinations being the UK, France, Italy. Yes, everyone there is doing very well. The star of the summer is probably going to be Italy, and it's projected that they're going to be up 50% year over year.
Wow, these are incredible numbers. Year over year, obviously, is a difficult comparison point. Are we back? Are we fully back in the tourism industry to where we were pre-pandemic? Have we made that? Is that the better comparison maybe to make?
It's uneven. Because you've got to look at Asia differently. You know, in the United States, North America, I think we came out of the pandemic more quickly, which ate up some of that earlier pent-up demand. Europe followed, and now I think Asia will start, I'll call it, riding that wave of positive momentum, because travel demand is really starting to come back very strongly in Asia Pacific. So it's uneven is what I would say as we come out of it.
Larry, great to catch up. Enjoy the 4th. Really appreciate your time today. Larry Kucelik, thank you very much indeed, the President and CEO of Best Western. Still ahead, Credit Suisse bankers are dusting off their resumes as the UBS takeover continues. We're going to have more on the changes next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Can you believe it's summer already? That means it's time for the Boston Pops Fireworks Spectacular. And Bloomberg will make sure you see all the fireworks, music, and special appearances by pop superstars En Vogue, chart-topping country duo Low Cash, and film, TV, and Broadway powerhouse Mandy Gonzalez. Plus the U.S. Army Field Band and the cast of the Broadway musical Ragtime. It all starts tonight at 8 p.m. Eastern right here on Bloomberg Television and Radio.
Okay, let's get back to the banking sector. Credit Suisse's private bankers have been told to dust off their resumes ahead of the selection of new managers following the takeover, of course, by UBS. What does this actually mean? I'm assuming the wealth management business is the bit that UBS actually wants. So let's figure out what the story is. Bloomberg's Tom Metcalf joins us now. Tom, walk us through the story. So what is the message that is going out?
Yeah, look, I think you're right. I think this is a pretty clear sort of bright spot, I suppose, for some Credit Suisse workers, but those in the wealth management unit. Effectively, that is, as we know, the part of the bank that UBS wants to keep. And I think you can take from this message that they are still hoping to keep at least a substantial portion of, the workers at Credit Suisse who might come over. I think if you actually read the letter, it's quite amusing. It's kind of caught between two worlds. Obviously, they're still planning to make some people redundant, just given how sort of frosty and sort of cold the letter is. If I sort of received it, I don't know how I would feel about my prospects at staying at the firm. But ultimately, yeah, I think you could take it as a sign that UBS is still trying to keep hold of as many wealth managers as possible. And, that compares, of course, with the investment bank where, the messaging we're hearing is it's pretty much very, very steep cuts, particularly in the trading side of the investment bank.
But presumably there are other banks out there as well that are also trying to poach some of these wealth management staff. Is UBS having to compete to retain?
Yeah, look, at the top level of the talent, that's who UBS are really trying to keep. And we've already seen lots of people walk out the door. So, at those sort of prized workers, the ones who've probably got the relationships with the richest clients, I suspect a big chunk have moved. And if they haven't, they're the ones UBS are really focused in on. This sort of particular initiative is focused more at those looking for sort of lower ranking leadership positions. So, maybe a few of the household names. But still shows that, among kind of the rank and file, there's still appetite from UBS to keep some of these Credit Suisse wealth managers.
Tom, a couple of quick stories that I'd like to whip through. Nigel Farage, obviously of Brexit fame, now having issues with the availability of bank accounts. I see the front page of The Guardian on their website, former Brexit Party leader Coutts' bank account closed due to lack of funds. What is the reality here? What do we know about this? He is obviously claiming that there's political interference. What is really going on?
Yeah, it's really interesting. Nigel Farage using his platform to complain about his treatment. So we now know the bank was Coutts, the private bank of NatWest. And what he has said is, he's been discriminated against effectively, being booted out for no reason other than his political views. And since then, he's been unable to find a bank to replace him. So effectively, he's saying he's now unbanked in the UK. I mean, today, that was definitely his side of the story. And today you got a lot more detail, almost on the other side of the argument. Basically, Coutts has sort of a minimum threshold of wealth that they like their clients to have. And apparently Farage did not meet that. So they're saying it's a commercial decision, or this is what people close to the matter are saying, at least. And Farage countering that, hey, he's never been told that. And he's convinced it's because of his political lines. So it's one of those interesting things, and be inclined to call it a storm in the teacup, but for the fact the UK government has now got involved. It's obviously an issue close to some Conservative lawmakers' hearts, and they are saying we need to make sure no one in the UK can be unbanked, whatever their political views. And of course, it's just not clear what the truth of that is in relation to Farage yet.
And the latest on O'Day?
Yeah, we're seeing a few more details about the various funds under the OD umbrella, what's happened to them. So most of those fund managers are looking to move out or are moving out from under that name, as you might expect. And interestingly, today, we heard that a few of them, all these funds have basically been suspended. We've heard that a few of those fund managers are actually now asking for those suspensions to be unwound, which, I think the way to interpret that is that these fund managers who, were just part of the OD sort of corporate structure are getting more convinced and more confident that they might be able to survive as independent funds.
Tom, great stuff. Thank you very much indeed for the full update. We really appreciate it. Bloomberg's Tom Metcalf. Okay, what are we going to do next? Let's talk about what is happening in France. We've seen days of violent protests across the country starting to ease now. We're going to take a look at the damage that has been done to the French economy, to French business. That conversation next. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people